right, I think we'll go ahead and get started. I see some other colleagues trickling in. Good morning, everyone, and welcome to a very cold day in New York. My name is Lisa Chung, Director of FX and Global Rates in the Markets Group here at the New York Fed. A very warm welcome to everyone to our second annual FX Market Structure Conference. Building on the success of last year's conference, it's great to have so many of you here in person, and thank you to those who are joining online from around the world, which I think really reflects the truly global nature of this market. Before we get started, I'd like to quickly go over just a few logistical points. First, we'd like to remind everyone that today's conference is being live streamed to the public on the New York Fed website, and a recording will be posted soon after the conference. I'll also note that we have several members of the press joining us here in person, and so therefore any remarks that are made during the day will be considered on the record unless specified otherwise. We also kindly ask you not to take any pictures or recordings at the conference. As I mentioned, we'll be posting it. And we'll also open up for Q&A in person at various points for those who are here in New York. And finally, I'd like to thank my colleagues at the New York Fed for all of their really hard work in organizing this conference. So without any further ado, it's my pleasure to introduce New York Fed President John Williams, who will deliver welcome remarks, followed by Anna Nordstrom, head of the Markets Group, who is our keynote speaker this morning. John Williams is the President and Chief Executive Officer of the New York Fed. In that capacity, he serves as the Vice Chair and a permanent voting member of the Federal Open Market Committee. Before joining the New York Fed in 2018, President Williams was the president and CEO of the San Francisco Fed, which he first joined in 2002 and subsequently served as research director. He began his career as an economist at the Federal Reserve's Board of Governors, and he has also served in roles at the White House Council of Economic Advisors and Stanford University's Graduate School of Business. I'll also note that President Williams' remarks will be followed by a keynote from Anna Nordstrom, head of the Markets Group here at the New York Fed. Ms. Nordstrom has over 30 years of experience in central banking in the official sector, having served at the ECB, the IMF, and the Riksbank. Of most relevance to this audience, though, as many of you know very well, Ms. Nordstrom has been engaged on FX market issues for a long time and was part of the original working group that published the FX Global Code in 2017. And so with that, I'll turn it over to President Williams.
Thank you, Lisa, and good morning to everybody, and welcome here to the New York Fed. We're pleased to host the Foreign Exchange Market Structure Conference, now in its second year, as Lisa mentioned. And the success of our inaugural event last year has encouraged us to repeat this meeting every year. So this is the second, and we will look forward to today's meeting and future meetings as well. Now, the role of a well-functioning foreign exchange market is absolutely essential in supporting trade, investment, and finance in the U.S. and abroad. This is especially true within the context of an ever-changing financial landscape and an interconnected world. Financial stability implications are of elementary importance to the Federal Reserve, and ultimately having a deeper understanding of the FX market dynamics and structure helps the Federal Reserve ensure effective calibration of our monetary policy implementation and domestic and international tools. So for me, the conversation today is particularly important because I wear two hats when it comes to the FX market structure. Now, one is the local hat, and that's, like I just mentioned, to deliver on the important mission of the New York Fed and the Federal Reserve System more broadly. But the other hat I wear is an international one, and that is my role as chair of the BIS Markets Committee. Together with a committee of central bank leaders from around the world, we serve as a conduit between BIS governors and the Global Foreign Exchange Committee. We participate in the review of the FX Global Code, a set of global principles for good practice in the foreign exchange markets. And there's a lot of ground to cover. In one day. We've lined up a set of panels on key topics for this market and a roster of excellent speakers who are leading the industry as part of the program. You'll hear about the current macro environment's impact on FX spot and derivatives trading activity, the implications for FX liquidity and price discovery, ongoing structural dynamics in FX swap markets, trading and price formation, and how developments in FX settlement risk and innovation would continue to influence the changing structure of this market. Now, the goal of our conversations is to advance the frontier of knowledge about issues that are important for the evolving structure of the FX market. And each of these topics is relevant to understanding the implications for the Federal Reserve's objectives and our mandate. And the New York Fed has the unique opportunity to share research and expertise in this space, as well as to learn from policymakers, world-class researchers, and the market participants here today. So thank you to the conference organizers for their leadership and diligent work putting together the event, including members of our markets group. And thank you all for participating. Given the excellent discussion topics and speakers we've lined up, I have no doubt that we are in for an engaging and thoughtful discussion. So now I'm going to turn over to my colleague Anna Nordstrom, the head of the markets group here at the New York Fed, to share her views in her address. Thanks.
Thank you, Lisa, and thank you very much, John, for those nice opening remarks. So good morning, everyone, and welcome to the New York Fed. I am very pleased to see industry and thought leaders coming together today for our second annual Foreign Exchange Market Structure Conference. I look forward to building upon the success of the inaugural event and continuing our dialogue around the evolving structure of this very important market. It took a lot of behind-the-scenes work to put this conference together, and I want to thank everyone involved who made this possible. With over $9 trillion in daily turnover, the FX market is the largest financial market by trading volume. I think of it as the circulatory system for the global financial markets and the global economy. This market plays an essential role in supporting the flow of cross-border trade, investment, and finance, and facilitates important risk management. It also supports the smooth transmission of monetary policy. As such, it is critical that households, corporations, and financial institutions can access and transact in an FX market that functions effectively and efficiently. Today, I'll begin by briefly discussing the New York Fed's role in the FX market. Then I'll look back at some of the dynamics that influenced FX trading this year. And I'll look ahead to the innovations in technology that are expected to come into play in the near term. Before I go further, I want to note that the views I express today are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or others in the Federal Reserve System. The New York Fed has a unique role in the Federal Reserve System. The Open Market Trading Desk implements monetary policy on behalf of the Federal Open Market Committee, and it monitors financial market developments. The New York Fed also participates in the FX market at the direction of the FOMC and the US Treasury. It conducts FX transactions for official sector account holders and manages international dollar liquidity facilities. Given this mandate, it is critical that we have a deep understanding of the factors that drive the structure and function of the FX market so that we can most effectively carry out our responsibilities, support policymaking, and promote good market practices. In looking back at the events of 2025, I think we can all agree that it's been a busy year for markets. I'll start by briefly highlighting some notable events. First, attention to macroeconomic events returned FX spots and derivatives markets to the forefront. This was particularly true regarding trends in global asset allocation amid heightened uncertainty in US trade policy. In this context, market participants remained attuned to whether there are ongoing material shifts in the US dollar's share within global portfolios. While available data show little evidence that foreign-denominated asset allocation has changed, fund managers have discussed the potential for reducing dependence on US dollar-denominated assets in the longer run. Still, many have noted that there are few current alternatives to US assets that offer similar liquidity and market depth. Fund managers have also noted that higher relative returns offered by US assets are discouraging diversification away from the US dollar in global currency and asset allocation. Hedging activity is another relevant theme this year. Some global fund managers increased their FX hedge ratios of their US asset holdings, particularly amid the notable dollar depreciation in April. This comes following an environment over recent years where hedge ratios have been reportedly stable at historically low levels. These anecdotal reports are echoed in the results of the BIS triennial survey, which measured activity over the course of April and offers some evidence of potential adjustments to global investor hedge ratios. The BIS triennial survey showed a 42% increase in spot FX activity since 2022. And there was an even larger volume increase for forwards and options, which were up 60% and 109% respectively. While it is difficult to show a direct link from these data, the sharp increase in these products compared to previous year's surveys is consistent with an increase in FX hedging activity back in April. I am eager to hear the perspectives of our panelists on these and other FX trading dynamics in our first discussion of the day. Given the various factors at play and the fundamental significance of the FX market, it is important to examine how periods of elevated volatility may impact market functioning. There were multiple periods of volatility over the course of this year, and a particularly acute period in April tested the resilience of the FX market. The market withstood those pressures, as evidenced by fairly stable bid-ask spreads, market depth, and price impact measures. Trading volume on primary platforms also increased notably, as is typical during periods of more volatile episodes. This period of increased volatility renewed market attention on the implications of the decentralized execution landscape for the quality of liquidity and price discovery. I imagine there are varying views, even among this audience, on how to assess those implications, and you will hear some of those perspectives today. It is essential that the structure of the market can accommodate a diverse set of market participants in reliably executing transactions, even amid periods of heightened volatility. The market is not a one-size-fits-all. So looking ahead, innovation will remain an important factor in the evolution of FX market structure. Some key technological advances, which could have a range of impacts, may affect both the overall structure of the FX market and also how FX trades. For example, artificial intelligence may increasingly be used to enable more efficient workflow, including automated trading strategies like algorithmic-based execution. This could lead to an even greater reduction in average trade sizes, as large orders would be more efficiently split into numerous smaller transactions. Although AI-supported algorithmic-based execution could minimize market impact, it could potentially also increase opaqueness and impact the ability to identify emerging risks. Modernization in payments, increased usage of stablecoins, and transfers of tokenized deposits across jurisdictions may affect FX trading processes by accelerating the speed of trading and extending liquid trading hours across the FX market. Yet, faster trading and longer trading hours may also increase liquidity risks and volatility in the FX market. To better understand these advances and their implications, the New York Innovation Center at the New York Fed conducts research and analysis on new financial technologies. At the New York Fed, we also engage with our US FX Committee and with the Global Foreign Exchange Committee on market structure evolution. Given the importance of technological innovation in FX markets, we have dedicated a panel today to this topic. I'm interested to hear panelists' views on which innovative technologies they expect will make the greatest impact over the next few years. Finally, I would be remiss not to highlight the Global Foreign Exchange Code, or the Global Foreign Exchange Committee's recent update of the FX Global Code. This is near and dear to my heart. as I have been involved with the code since its 2017 launch. The code is a set of global principles that promote integrity and effective functioning of the FX market. And the New York Fed, together with other central banks, partner with the industry in support of these principles. As we talk about the various forces that have been shaping market structure, as well as the changes that we see ahead, it is important to ensure that the principles of good practice remain up to date and fit for purpose. For this reason, the Global Foreign Exchange Committee is strongly committed to regular reviews of the code. The most recent updates strengthen guidance on FX settlement risk and recommended increased transparency around certain types of FX transactions and client-generated data. As part of this effort, the New York Fed worked closely with industry members on the US FX Committee, and I want to thank all members, many of whom are here today, for their valuable contributions and their support in promoting good market practice. I'm looking forward to hearing from the buy-side firms about their views on this topic. Before we go to the first panel, I want to take this moment to thank all of you for being here. This event is an important forum for convening people with different perspectives and expertise to help us better understand the past, present, and future of this critical market. Already, it is exciting to see how this annual conference has grown from last year. I look forward to hearing from all of you over the course of the day, and I hope you enjoy the conference. Thank you.
Right?
Is it in order?
Yeah, do you want to sit in order?
Okay.
It's fine.
Okay, that's fine.
Come on.
So
Then we are for sure.
There we go.
welcome, everyone. I'm excited to be moderating our first panel of the day, the macro environment's impact on FX hedging activity. So as I was thinking about sort of a jazzy introduction to this panel, I actually put into AI, I'm moderating this panel on FX markets, and the first panel is on hedging activity. What should I say to introduce the panel? And I don't know, I'm getting a little worried about future moderation out here. But so the material I got back was, much like navigating the New York subway at rush hour, FX markets this year have been crowded at times, occasionally unpredictable, and if you weren't paying attention, you might have ended up going in the completely wrong direction, which I thought was pretty accurate. But indeed, as Anna mentioned, it's been quite a year for FX markets. Following the US tariff announcements, the correlation between the dollar and risk assets broke down. And market participants, at least from what we've been hearing from the industry, have theorized that the hedging of currency risk by non-US investors played a very important role or a contributing factor to dollar depreciation. And all of this was taking place after years of non-US investors not hedging their FX exposure, given the strength of the dollar and hedging costs. So naturally this year, this has been a very big topic, as our esteemed panelists know very well. So to help us dig a little bit deeper into kind of these FX hedging dynamics and their impact on trading conditions, we have a terrific panel here with the experts in this space. So just by way of introductions, I think everyone has everyone's biographies in your materials, but I'd like to introduce Adrian Bowler, Global Head of Macro Sales at UBS, Dagmara Fiakowski, Head of Fixed Income and FX at RBC Global Asset Management, Gerardo Garcia, General Director of Central Banking Operations at Banco de Mexico, and Chris Pizzotti, Global Head of FX Sales and Trading at State Street. So to kick us off, Adrian, maybe I'll start with you. Again, we've heard this year so much about FX hedging activity driving the dollar, and institutional investors outside the US really at the center of that activity, reducing their currency risk. So in the most basic terms, maybe to level set, can you explain kind of the historical or typical behavior of non-US investors when it comes to hedging their FX exposure in this space?
Sure. Morning, everyone. Thank you very much for having me, Lisa. So What we, of course, will all quickly agree on is any discussion around hedging behavior is a complex, multifaceted discussion. Hedging behavior differs as a function of jurisdiction, as a function of investor type, as in function of asset class too. But I think what we can say at the highest level is over the past 2 decades, we've seen allocations to US assets by non-US investors increase very meaningfully, sixfold, approximately in dollar terms. And that's been driven by a number of different factors. So increased US asset outperformance, the general stability and strength that was alluded to before of the dollar over that period, and of course, active increased asset allocations. As exposures have grown, that's been accompanied by an increase in hedging activity, an increase in hedging ratios, and there we estimate that since the global financial crisis to 2020, hedging ratios have roughly doubled to between 35 and 45%. Now, despite higher hedge ratios and the fact that hedging has become a little bit more systematic, a bit more programmatic, the net output of that dynamic is the stock of unhedged US assets has grown materially simply because the pace of US asset holding increases has materially outstripped the increase in hedging.
And of course, as you mentioned, it's a very complex space. So how does it differ across jurisdictions or different investor types
Sure.
as people think about kind of where they sit in the ecosystem?
Sure. So let's deal with jurisdictions first of all. So the natural incentive, if you like, to hedge is very much a function of the domestic currency's correlation to risk. So at one end of the spectrum, we will have a jurisdiction like Australia. We know that's a risk-on currency. So when we enter a risk-off environment, the Aussie dollar tends to weaken, and that actually can offset portfolio losses in unhedged US holdings. And consequently, that leads to us observing typically lower hedge ratios, approximately 21%, for instance, on US equities for Australian superannuation funds. And then at the other end of the spectrum, you will have a jurisdiction like Switzerland, where we observe the opposite dynamic, where the Swiss franc is a risk-off currency. It tends to appreciate in a risk-off environment, and consequently, that actually can amplify losses in underlying unhedged holdings, and consequently, that leads to typically higher hedge ratios, approximately 60% for Swiss pension funds, for instance. And then you have, and this is what makes it a very rich tapestry out there, you have the exception to every rule, and you will have a jurisdiction, for instance, like Japan, which exhibits all the same correlation behaviors as Switzerland, and should lead to typically high hedge ratios, but there we observe historically low hedge ratios, and that's possibly driven by higher cost to hedge, and also just perhaps institutionally higher levels of risk tolerance for currency. So that's the jurisdictional dynamic. And then we can have a very long and protracted discussion about how investor types also influence hedging behaviors. If we have typically liability-driven investors, they will typically look to match overseas assets to domestic liabilities and consequently are more actively involved, all other things being equal, in FX markets. And then you might have total return investors who are looking to optimize performance and therefore will be a lot more tactical in their hedging behavior, and consequently we will typically observe higher volatility in their hedging ratios versus the liability matches. And then perhaps one final word around differences in behavior around asset class. So the equity investor, the largest component of their total risk comes from the equity volatility, which typically tends to be much, much higher than currency, and therefore we typically observe lower levels of hedging activity in FX for the equity portfolios, and the converse holds true in fixed income, where the FX component to the overall risk is a higher contributing factor, and there consequently we see higher levels of FX hedging. So many moving parts, but hopefully that helps set the scene.
No, thank you, Adrian. That was very helpful, especially to hear kind of about the foreign perspective on hedging. Chris, I wonder if you could maybe just comment on, from where you sit, how you see the behavior of U.S. and non-U.S. investors, and how do you assess that over time? I think State Street at times has come out with certain data or data points that shed some light on this, because we understand it's very difficult to actually measure precisely, where people are in their hedging.
Yeah, and State Street's in a unique position based off the custodial data that we're able to see. And I think it's been very interesting, and you talk about, are they static or dynamic? And obviously, Adrian did a great job of laying out what impacts hedge ratios over time. And if you look at basically 4 or 5 years ago, interest rates, near zero, hedge ratios were very high for foreign investors, and then they've kind of just drifted lower as U.S. rates, Fed had an aggressive hiking cycle. So those have changed, and now we're at relatively lower levels than we've been historically. We've gotten a lot of questions this year, obviously, around Liberation Day and the impact both on U.S. and non-U.S. investors over the past 6 or 7 months. What's been really interesting is a lot of people always focus on, obviously, the foreign managers, but the actually more pronounced activity has actually been from U.S. domestic investors and their hedge ratios of their assets overseas. So if you look at where we were compared to where we are now, U.S. domestic investors have basically halved their hedge ratios over the past 7 months. So taking a view and selling dollars and actually reducing their hedge ratios of their foreign assets. The foreign investors actually, the actual ratios haven't adjusted that much, which has been pretty surprising. A lot of people would have expected that foreigners would have been a lot more aggressive in increasing the hedge ratios. And we've had a lot of internal conversations with our strategy team and what's really driving that. And I think a big part of it is just cost, right? So if you look at over the past 4 or 5 years, a lot of people have been buying U.S. assets unhedged because of the U.S. dollar, the rate differentials, et cetera. But as you look forward into 2026 and the years ahead, if you look at, there's a few cuts priced into the Fed. Some of the other developed market central banks actually have hikes priced in. If you see those rate differentials converge, then the cost to hedge cheapens up, and I think you could see an increase in those hedge ratios moving forward, especially considering the fact that they're at relatively low levels historically, when we look at our data. So there's also some nuances depending on where you're looking at from a country perspective. There's some interesting stories, even in Canada, some of the domestic hedge ratios have gone lower, and some of the speculation is that that's a rotation out of U.S. Into Europe unhedged. And so I think some of the larger stories and effects of Liberation Day can be seen in different swaths of the data and some of those rotations from country to country.
I know Chris and Adrian, you both travel around the world extensively. When you speak to clients, are there particular geographical jurisdictions that you get the most questions from about hedging or how to hedge or how to think about their hedging strategy?
Obviously, it's front and center. I mean, just to reflect my own personal experience, it's front and center of everybody's portfolio. We get plenty of questions about what this all means. Is the dollar losing even a part of its shine as a safe haven status, and what's the alternative in that scenario? But very, very quickly, and I think, Anna, you referred to this in your opening comments, we get back to the question, what is the credible alternative? And that, I think, is also one of the strongest impediments to people dramatically either reducing US holdings or increasing their hedge ratios, because we all very quickly come back in those discussions to, where else can I put my assets? So I think that helps explain the dynamic that Chris articulated, and we certainly echo that in what we've seen from the non-US component. There's been the non-US component of the franchise. There's been tactical ad hoc increases in hedge ratios, but those have gently gravitated back to kind of where they were at the beginning of the year. And it's interesting that we're ending the year with volatility on an absolute low, positioning just generally also probably on an absolute low, and everyone is possibly quite happy that we can take a little bit of a breather after the epic year that we've had. But I think that, coming back to the crux of the issue, the absence of a credible alternative is probably meaning that people are a little bit reluctant to materially make structural changes in the way they think about hedging their currency exposure.
Yeah, I would echo everything Adrian just said. I think he hit the nail on the head. When you're trying to diversify away, especially after an event like Liberation Day, there's a lot of speculation that people maybe would look to de-risk from the U.S. or diversify their exposure. But the big scheme of things, when you look where a lot of the growth, you look at the technology names in the U.S. equity markets, people still want to be heavily invested into the U.S. And when you talk about where you're going to sell the U.S. assets and reposition yourself, there's not many places in the world with the depth of markets and the diversity that the U.S. offers. And I think that's where people have struggled when they talk about rotating out of the U.S. I mean, having said that, I think there's been some areas like the Eurozone that have benefited. If you look at the Euro and some of the investments there, I think that's one area where we've seen our data where people have been investing more. And I think because of the depth of markets, et cetera, then that's a more viable alternative, but not many other places globally that they can put their money outside of the U.S.
Thank you, Adrian and Chris. Dagmar, let me turn to you. From your position and your perspective on the buy side, how do investors think about hedging their fixed income versus equity investments? Adrian kind of alluded to the fact that there are different strategies based on the asset class. How are you thinking about that, and what do you hear from your colleagues on the buy side?
Yes, thank you, Lisa. The starting point, I think, whenever you're thinking about policy and setting up a portfolio, is absolutely the volatility of the asset class. So Adrian mentioned that given, you're thinking about combining two streams of returns, both with the same volatility, approximately high volatility like equity and FX, and you are not getting a benefit of risk reduction from hedging. But when you think about fixed income, an asset class with significantly lower volatility, say 4 or 5%, combining it with a stream of returns from FX volatility at least twice as high, you're going to end up, if you don't hedge, you're going to end up with a portfolio of currency returns with a sweet little kicker of fixed income returns. And in the meantime, you're calling yourself a bond manager. So the natural stance is to be a hedged fixed income portfolio, potentially having an active currency overlay if you have that capability. But the policy, natural policy for fixed income managers typically is fully hedged. On the equity side, since it's not reduction volatility, what other reasons might incline you to hedge? And there are some may be as simple as predictability. As a mutual fund equity manager, frequently equity managers are focusing their mind on earnings and PE ratios and growth outlook, etc. And currency is not very forte. So if you want to have somewhat more predictable returns related to how the manager is managing, you may choose to hedge fully or partially. But often people do the 50%, the least regret ratio or nothing. And Adrian, you alluded to the safe haven qualities or risk-on qualities of some currencies. And Canadian dollar, like Aussie dollar, frequently had that quality. So the typical action would be not having hedges on equities or higher vol, high yield or EM, for example. It's slightly different in private assets and in liquid assets. And I want to comment on that because these assets have taken bigger portion in global portfolios. On the very surface, you might think that these are low vol assets, so let's treat it like fixed income and hedge them. However, given their illiquidity, it may be quite difficult to hedge them operationally because you don't have easy cash flows. You don't, unless you choose to hold a portion of assets in cash, or have line of credit, or try to match the flows with the flows of dividends or interest payments, income from these assets. So often, given the very long-term nature of these investments, the private illiquid assets end up being not hedged. Now, that all has slightly, that's the starting point for the strategy. But I think in 2025, a lot of long-term asset managers have asked themselves the questions about the strategy going forward. And I think that question is very much driven by what I call too much of a good thing. Too much of good returns, good from US equities for foreign asset managers, which resulted in extreme over-concentration of portfolios, global equity portfolios, in US. At the end of 2009, in MSCI World, US equity weight was 47%. At the end of 2024, it's been 72%. And that's the result mostly of appreciation of US equities, higher than other equity markets, appreciation of the dollar versus other currencies, and somewhat flows. But flows were actually the least important component of this, this phenomenon. So as a foreign equity or foreign portfolio manager, you of course are super happy from that. But you must ask yourself, is 72% allocation to US equity market suitable for my investors, for our liabilities? And the most interesting thing is that, you know, in 2009 or any other year soon after financial crisis, nobody was asking themselves, is it right to increase US equities to 72% or 70%, or, you know? Nobody made a conscious decision of, oh, we're going to over-concentrate in US. But having found ourselves in this position 15 years later, you must ask that question because your portfolio became super concentrated, very procyclical, and very overweight US dollar.
So Dagmar, you had mentioned the challenges of thinking about hedging certain asset classes, specifically private credit, private assets. How do you think about the different instruments? Like when you think about, okay, you know, we have a hedging strategy now, we're going to increase our hedging in our fixed income equity or private credit. How do you think about the actual instruments you use? And has that changed over time based on the cost of hedging and other, you know, interest rate dynamics?
Cost of hedging is absolutely first on top of mind when you're thinking about choosing how to hedge portfolios, or even if you're going to hedge them at all, right? You mentioned the interest rate differential that has prevented people maybe from acting immediately, and I think in 2025, part of the reason why we didn't see this immediate follow through after April is these interest rate differentials, especially if you are a Canadian investor. And Canadian dollar, after initially appreciating, started drifting lower, or US dollar higher, based on many factors. But among others, like the uncertainty about USMCA negotiations is something that is really hanging over the currency. While it's happening, the investors who are contemplating increasing hedges, they have no urgency to act at the moment. In addition, that while you're waiting for the interest differential to move in your favor, you also have no urgency to act. So looking, for example, at the Canadian dollar, I think if we had US below 137, there would be a lot of, oh my God, did we miss it phenomenon, right? But while you are near 140, there is absolutely zero cost to waiting, right? And it actually may be advantageous. In terms of choice of instruments, I think we're still looking mostly at FX forwards. That's something that you can customize, sizes, dates, diversify. For us, where we are running very large hedging programs, being able to stagger cash flows so that they are not disruptive to underlying asset managers is extremely critical. And for that reason, futures are really out of the picture. Options are too expensive. So FX forwards is it for us.
Thank you, Dagmar. So we've mentioned Canada, Australia, the UK, and the Euro area. Gerardo, I want to ask you about the emerging market perspective and what's the view from EM investors in terms of hedging, and also the official sector, given you're coming from the central bank.
Sure, thank you for having me, and let me start with the usual disclaimer that these are my own views and not necessarily Central Bank of Mexico views. And let me also begin by just giving a context on how important the dollar is for central bank portfolios. Then I will talk also about pension funds, asset managers, but let me start with the central banks. And it's important for me to say that 60% of the central banks use the US dollar as their numeraire. And this is significantly important because when you have the dollar as numeraire, you don't have that many incentives to hedge. So if you use the US dollar as numeraire, no hedging pretty much. But the other 40% have another currency as the numeraire, so they might have some incentives to hedge, but that has been discussed. This depends on the correlation of the currency of the numeraire with the dollar and also about the costs of hedging. Now, in terms of the representation of the dollar in reserve management portfolios, it's around 56%, and this is IMF data, and this is coming down a little bit from what we saw like 3 years ago, which was 60%, but it's clearly that the US dollar is the dominant reserve the dominant currency in reserve portfolios, followed by euro, and then you also have the sterling and the yen, but the US dollar is by far the most important one. Obviously, in the first half of this year, when we saw significant currency depreciation, all central banks started discussing if there were alternatives to the dollar. And I can say, just by talking to my many colleagues in Latin America, but also with my emerging markets colleague in the Markets Committee, that there are few alternatives to the dollar because of what has already been said. When you think of the size, the liquidity, and depth of the US markets, there is no real comparison to that. But there are a few alternatives, and I think one asset certainly stands out, and that is gold, bullion. So basically, when you think of gold, I think it has significant properties for reserve management, one of which is that it has low correlations or even negative correlations to some traditional reserve assets. Obviously, it has also some safe haven properties. So when you think of the current scenario of global uncertainty marked by political tensions, trade disputes, geopolitical conflicts, then gold often does well. So certainly gold is something that central banks have been doing, and it is no surprise that central banks keep buying gold. So for instance, in the years before 2025, central banks were buying gold around 500 tons per year, and now in 2025, 2025, they have bought around 1,000 tons per year. So, sorry, the pre-COVID average, 500 tons. And now, after COVID, it's 1,000 tons per year. So the significant purchase of central banks of gold is something to really highlight. And the other aspect that I would like to mention is that, in my view, there are a few countries or regions that could benefit from this looking for diversification alternatives within the central banking community. One is Europe. Europe already has some markets that are attractive in terms of size and liquidity, and in my view, if they address the fragmentation of their markets, they will really drive inflows into their economies and into their region. The other one is China. I know China has now lower interest rates than those in the US, but China has become a very, very important trading partner for many emerging market economies, and I'm talking about Latin America, Eastern Europe, also Southeast Asia. So I think China also has a chance to increase their participation in reserve management allocation. I'm not saying, obviously, that they will threaten the status of the dollar as being the dominant currency in reserve portfolios, but I believe that they could earn or gain some market share going forward. That's in terms of central banks, but let me just very briefly address what's happening in other investor types, one of which is asset management. And we have had discussion with asset managers in the region, and I think one thing that stands out is the fact that they have seen outflows from US dollar investments and inflows into some less traditional asset classes. In fact, the ETF with largest growth recently has been that of Bitcoin. So crypto, I think it's an asset just to keep an eye in terms of what we have seen in asset management. Then if we look at private wealth management, and this is family offices, and this is talking mostly about what has happened in Mexico, what we have seen is a repatriation of flows. So that means people taking money away from the US and back into Mexico. And I think this speaks a little bit about the disappointment in some way to the US exceptionalism story, and also for the fact that in Mexico and in emerging market economies, we continue to have high rates. So there's a carry component, and if you keep your money in the US, which is lower yielding and with a depreciation trend, then you end up losing money. So that's what we have seen in private wealth management. And in pension funds, we have also seen an interesting aspect, which is not so much hedging the dollar and not so much like leaving US dollar assets, but the marginal income has not been invested in US dollar assets as it was before. So I think that's also an interesting trend that it's worth mentioning. So with that, let me make a pause here. Thank you.
Thank you. So I think, overall, this topic is quite broad, but there's obviously a lot of complexity and nuance based on the investor type, motivations, broader macro outlook, cost of hedging in different instruments. There's been quite a bit of volatility this year, but Adrian, as you mentioned, we're heading towards year end and it's quite low. What do you think has been the impact of changes in hedging or investors thinking about hedging on market conditions, actual trading conditions?
Sure. So I guess we can break that down into two components. There's the liquidity component and then market structure looking forward. I think if we project forward into a scenario whereby hedging activity were to increase substantially, I'm not saying that's our base case, it's not our base case, but in the scenario that we do see a large increase in hedge ratios, and just to frame it in numbers, our analysis suggests that a 5 percentage point increase in hedge ratios equates to potentially $1.4 trillion that need to be recycled. So we're talking about meaningful numbers. I'm actually less concerned about day-to-day liquidity than I am perhaps about some of the market structure implications, because what the FX market has done is demonstrated tremendous resilience, even in the face of really marked and difficult dislocation, not just this year, but in recent years, and we're all acutely familiar with those particular events. Of course, bid-ask spreads widen, but core market functions remain robust. Price formation, the ability to execute, the ability to settle. So I'm less concerned actually about day-to-day liquidity. I think other potential capacity constraints come more into focus in the event that there is a large increase in hedge ratios. Obviously, large proportions of the institutional franchise globally have had access to FX hedging on an uncollateralized basis. If we're talking about materially larger quantums of outstanding hedges, then with the cost of balance sheet for dealers going up because of regulatory capital requirements, I wonder if there's a scenario whereby the willingness or the ability to keep warehousing uncollateralized hedging activity continues. And I think under that scenario, there is the possibility of higher collateral requirements for institutional investors, and possibly as well, higher hedging costs associated with hedging activity. And I think, furthermore, as we will observe, hedging flow oftentimes is very concentrated around a number of key dates. That's very much a well-instituted pattern across the institutional client base. So forwards, to your point, Dagmara, are often concentrated around month end or IMM dates. We had a very, very big IMM settlement this week. And of course, that results in many, many transactions being processed through a very, very small window. And of course, if we're talking about that quantum increasing, then the scope, particularly if there's market dislocation, for there to be an amplified impact on widening bid offers, even if it's on a temporary basis, the ability for there to be increased settlement and operational risk, I think, is also something that we need to think about. And under the most extreme market dislocation, the potential for there to be forced asset sales if liquidity buffers aren't sufficient is also something that we need to think about. Now, I think the good news is the industry is already thinking about this. We are starting to see innovation around hedging products, around hedging strategies, and also discussions around collateral and balance sheet optimization. Populate our discussions with our clients much, much more frequently. And that, I think, is a very welcome discussion because it makes the ecosystem that we're all participating in much more sustainable and much more resilient. But I think under the scenario where there is a material increase in the quantum of hedging, which again isn't our base case scenario, I think the industry needs to spend more time thinking about what that looks like in practical terms.
Maybe I'll open that up and see Chris, Dagmar, Gerardo, if you had any reactions or.
No, once again, I'm in agreement. I mean, I think he hit the points really, really well. And I think if you talk to most banks, especially in the U.S., a lot of the conversations around capital and liquidity are top of mind. And especially if you start to see an increase in hedging activity, especially in the uncollateralized forwards, that puts a lot of stress on balance sheet and liquidity consumption for banks. So to Adrian's point, I think there's been a lot of conversations around innovation and different products that could cheapen or have some relief for the balance sheet. To Dagmar's point before, the FX forward market is extremely liquid and deep. And I think the problem a lot of times with these innovative products is there's just not that depth and liquidity that you want to be able to actually meaningfully change some of these hedging strategies. I think that can change over time, and I think there's a lot of good innovation going on across the FX markets right now. But I think, to Adrian's point, those conversations with clients around collateralizing, forwards more traditionally and having more dynamic conversations about trying to internalize more, do different things even internally at the bank to be able to continue to scale with clients and be able to build those relationships are definitely the main points. So completely agree with Adrian.
I'm not sure whether the base case should be more hedging, but I think the base case should be recognizing that there will be less US dollar exposure in the portfolios over the next 5 years. Somehow the asset managers are going to drive to accomplish it. And if you think about it from their perspective, they can do it in one of several ways. The least involved is that new flows will be directed towards other regions, right? So that will take a very long time. But on a relative basis, from the both currency and asset price perspective, EM markets, European markets look quite attractive. So you can choose to put new flows towards that. Another way would be, of course, to choose hedge currency only. And you can make an argument for that from the perspective of currency cycles, dollar valuation. Again, that would be a tailwind for the other currencies against the dollar over the next number of years. And the most drastic would be, okay, we're going to reduce also the allocation to the stock market. And because of the disruptive nature to portfolios, you're going to do it over the next number of months, quarters, whatever time horizon is appropriate for your assets. And that's what I think may happen over 2026, 2027. And looking at just 2025 in the case of longer horizon portfolios is a bit of a mistake because we're looking at, it happened in April and then nothing. But by the time these decisions get made and the process gets put in place to accomplish that without too much of a disruption to portfolios, we're talking implementation plans that are ahead of us rather than behind us. And that can lead to, again, this headwind for the dollar in particular, even if the foreign asset managers don't want to bet against US ingenuity and liquidity and attractiveness of US markets.
Gerardo, do you want to add anything?
So maybe just a word on market functioning and what happened with some of these vehicles, because I think one striking feature this year was the fact that markets proved to be very, very resilient. Everything really worked well, whether it was forwards, whether it was swaps, whether it was options. In fact, one of the things that is really to highlight in Latin America is the fact that we have experienced very low implied volatilities in option markets, which is quite surprising given the amount of uncertainty that there is out there. And I think that speaks also for the difficulties of really trying to price out tail scenarios. So the main scenario is that, yes, we have some trade concerns, trade disputes, but the main scenario is that it will be sorted out. So pricing really the tail scenario has been really difficult, and I think that explains a low volatility in terms of their use of hedging. Having said that, the volatility curve is very low in the short part of the curve, but it's steeper in the long part of the curve. So that is also something that it's maybe just a caution, a sign of caution going forward. In terms of emerging markets and in terms in Mexico, for example, the negotiations of the free trade agreement are coming next year. So that explains also the volatility is a little bit higher in the long part of the curve. And also one thing that I would mention is that in terms of the FX basis, we saw those spreads narrowing. So this dollar cost in the FX swap market, it came down, probably because of the overall trend of the dollar, which depreciated, but I think it also speaks for the fact of what Mara is saying, that maybe going forward, the demand for the dollar will not be as much as before. So I think those are some important things to consider. And in terms of asset allocation, I will also second Dagmara's comment. Going forward, most of the asset allocation decisions, at least for central banks, will be done by the beginning of next year, January and February. And it will be very interesting to see how all this plays out in terms of the allocation to US dollar assets, because I agree with you that there may be some rebalancing, which will be very gradual in terms of further diversifying portfolios, maybe a little bit away from the dollar and into other currencies and asset classes.
Thank you. So it sounds like, with 2025 in the rearview mirror, we have many things to monitor and keep track of in the next year and years, it sounds like, just based on kind of the cautious approach and rethinking that some of the buy side and asset managers have about their allocations, and that may have implications for how the banks and liquidity providers think about trading conditions going forward. So we have a few minutes for questions, so I'll pause here and see if anyone in the audience would like to ask a question. Yes, at the front.
Oh, great. Thank you very much. Rich Kachinos from RBC Global Markets. I guess I have two questions. I'll start with the first one, which is why, when in an environment where FX volatility is trending lower, and when we look at the volumes which are traded in the FX markets, those have gone up quarter over quarter, year over year. The BIS data, which you guys have alluded to, has really pointed that out. Where we see volumes moving higher in the market, but the volatility and risk of the market is moving lower over time. And where this comes from is, I guess when I think about VAR and when I think about risk in currency and specifically about hedging, whether we're using the appropriate measures of risk in FX kind of embedded in the asset allocation. So it's a very open question, but given the breadth of the panel, I was hoping that they would comment on that in terms of their views and their thoughts.
Thank you. Anyone want to take a stab at that one?
So I kind of mentioned it that, for example, when you think of volatility going lower, I think it has to do with the difficulties of pricing out very negative scenarios. It's very hard to think of out-of-the-money options being like very expensive if you really think that the tail scenario is not gonna materialize. So I think in some way that explains lower volatility. So it's also a striking feature that I have seen. It's not something that I really feel very comfortable explaining, but I think that's a reasonable answer, or what I have heard in terms of how difficult it is to really price negative and tail risk scenarios. So hopefully that helps a little bit. That answers in some way the question. So for example, when you think of the skew of the volatility surface, that's certainly speaking out of maybe having a weaker dollar going forward. So that's certainly something that you would consider in your 2026 decision for asset allocation. And when you see other safe assets, the structure of the volatility curve, then you see the opposite. Like, for example, the Swiss franc continues to keep these properties of safe haven. So you would think that some of these safe haven currencies like the yen and Swiss franc could appreciate as opposed to the dollar that could depreciate. And that is looking at the volatility structure that you are mentioning. So those are some trends to consider going forward.
Kevin Chen, NYU. Two questions. One is, can you comment on the massive rise of gold this year and impact to the FX market? And second is, next year, stable coins coming a lot more. What would be the likely impact to FX market too? Thank you.
Sure. I'm happy to take the first piece around precious metals because we're obviously very big participants in the precious metals market. And I think actually what I'm going to do is reference all the points that Gerardo made because I think he encapsulated or covered that discussion very, very well. What we've observed is exactly the patterns of activity that Gerardo mentioned. So very, very strong demand for precious metals, gold in particular, of course, but we've had some immense volatility as well in silver from the central bank and official institution community. We think that's likely to persist over the course of the coming year as well. So we retain a very constructive outlook on both gold and silver for that reason. The structural demand in the system for it is rising. And obviously we have seen other market participants entering the market in precious metals and using it as a vehicle to express a view intrinsically on the dollar, but without necessarily encountering some of the other dynamics that have been presenting more structural headwinds for more strategic hedging that we've talked about in terms of cost of hedging and so on and so forth. So I think what we've observed in 2025 is likely to persist going forward.
Yeah, and I think just on the stable coin, I know that's top of mind at a lot of investors, and even at the FX committee, we had a pretty robust discussion around stable coins, et cetera. I think right now there's use cases across payments and even some in the emerging market space. I think longer term, from an institutional FX perspective, there's a lot of plumbing that needs to be able to be built out and affect this on a more institutional level, considering the liquidity and the size. So I think there's more of probably a 5+ year story to be able to do that. And I think obviously longer term, there is some benefits to integrating stable coins into the FX system. But for right now, there are some use cases across payments and a few other platforms that are very logical. But I think longer term, to have a broader impact across FX, there's still a lot of work to be done to be able to impact that on massive scale.
Yeah, and just on that particular point, totally agree. Even though I can't say the word, interoperability will be a key theme because obviously we serve, be it a franchise like UBS is or State Street, is a very, very broad church with very different requirements when it comes to activity in foreign exchange. And while I can conceive of a scenario where very sophisticated parts of the industry will move quickly to adopt and will be early adopters of new technologies, there'll be parts of our franchise that are naturally slower adopters, but we need to continue to support them. So I think for the ability to have an ecosystem which is interoperable between new and existing technologies is something that we're going to have to grapple with for some time yet.
In terms of stable coins, I think in emerging markets, that's a very important issue. And it comes from a financial stability perspective, but also from a monetary independence perspective. So it ranks very high in the agenda of all emerging market economies because there's this concern that some advanced economies currency could be more used in emerging market economies, and that could in some way impair the monetary and currency the independence of emerging market economies. So that is certainly something that will be very close look at in emerging market economies.
Alain Chabot, just retired from the Federal Reserve Board actually, but still working on FX. I have a question. Could you comment on the linkage, on the mechanics in a sense, of how adjustment hedge ratios affect the spot market? Do you see it more as the forward rate dragging the spot through parity conditions? You see it more as the behavior of the institution providing hedges, therefore entering the spot market themselves? Could you comment on that linkage?
Not me, certainly.
Yeah, I mean, just from, if you look this year, I touched on it before, so if you look at U.S. domestic investors and the fact that they're hedging less of their overseas assets, that's naturally going to create a need to sell dollars across the markets, because if they're rolling the positions forward, if they decide to not roll those positions and decide to take them off, then that naturally will lead to dollar selling across. So as we look into next year, and we talked about future, further pressure on the dollar as rate differentials converge, and you talk about hedging less or putting more, or the opposite, or even doing more from a foreign investor perspective, that will have actually impact on the actual currency rates and exposures as they start to do more hedging.
Last question, Chris?
Yeah, hi, Chris Chataway, Goldman Sachs. I have an easy question. Where will the dollar be this time next year? And then what do you see as the biggest risks in 2026? And perhaps your personal views, not the sort of official published views of the firms.
What?
Yeah, the disclaimer is always very important. Yeah. Well, it's interesting, and even hearing Dagmar and Gerardo speak, I mean, you can see the overhang, in my view, of Liberation Day is still there. And there's been a natural conversation about de-risking and diversifying away from the U.S. The U.S. and the U.S. exceptionalism story, I think, has lasted a lot longer than some have expected. And if you look at where U.S. asset valuations are right now, where they could be in the future, you have these conversations about risk allocation and talking through how long those implementations can be. I think we're still going to see another leg lower in the dollar moving forward. So my personal view, not State Street's view, to everyone else's, I do think that you'll see the DXY continue to grind lower. And especially as you start talking about more of these investment decisions and hedging decisions to come, and you talk about the rate convergence that at least is priced in right now. Now listen, the U.S. is still a very liquid, developed market. It's not going to be going away anytime soon because of what we've already talked about. But I tend to be in the dollar lower camp next year, and then think we could see maybe a 3 to 5% move, across 2026.
Okay, we're going to flip roles here. I'm going to agree with everything that that Chris has just said. So again, disclaimer, personal view only. I think this year has planted questions in people's minds re the US that weren't there before. So the propensity to want to sell more dollars to hedge, I think is there, and for the reasons that we've talked about, I think that's my personal base case scenario. I don't think it's a disorderly move by any stretch of the imagination for the other reasons that we've discussed, credible alternatives and so on and so forth. So order of magnitude, I'm in a very similar camp, actually, 3 to 5%. You asked a question around risks. Okay, I think there are scenarios under which that dynamic accelerates. Okay, be that the market increasingly coming to the view that there are scenarios whereby the dollar loses its shine for longer, and given the quantum of dollars we're talking about, the ability for that to overshoot in the short term, I think, is a risk. So while we're talking about 3 to 5%, it could be more extreme. I think the counter to that is history tells us that these big structural readjustments in markets play out over many, many years. And we've heard a number of reasons in the discussion today, the very interesting discussion today, as to why this should unravel slowly. So I don't think it would require something that is not really a base case scenario or a tail event for all of those really to accelerate at the same time. But I think that would be a risk.
My personal view would be that dollar will be lower. How much lower? I don't think really it matters. Not 1 or 2%, because that would count as nothing, but something higher than that. The biggest risk, I think we have a lot of risks. When I'm asked that question, I typically think about the risks that are not on the list of biggest risks, because these are appreciated by the market. Yes, more dovish Fed. Yes, more cuts in the second half of the year. I think the risk that is little talked about is reacceleration of the economy. I think we have forecast towards 3% at most if there is significantly more spending and consumption, and something higher than that then would potentially drive inflation higher, and maybe think about pricing for the first time hikes from the Fed down the road. So I think that's the risk that's not talked about at all at the moment.
So let me take just a macro view, and maybe not such a short-term view as 2026, but what happens going forward, because currency trends usually played out over years and even decades. So thinking that there will be a significant change in terms of the role of the dollar for 2026, I don't think so. And when you think of what makes currencies, the reserve currencies and the dominant currencies, there are a few aspects that the US will still have. So for example, when you think of deep and open financial markets, US stands first and will continue to stand first next year. When you think of the economy, the size of the economy, the openness to trade, which has changed a little bit, but it's still the openness to trade, the US will still dominate. When you think of the role of the institutions, rule of law, the strength of institutions, US still ranks very, very high. When you think of the safe asset supply, which requires fiscal sustainability, the US still ranks very, very well, although maybe the direction of travel is something that will be concerning, not in 2026, but going further. So full convertibility and capital mobility, that's something that the US will still have in 2026. And network externalities, which this means that once a currency is widely used, it continues to be used and it will become widely used. That is still something that the US dollar will have. So some of these aspects, certainly the direction of travel, maybe in the last few years and 2025 has not been that good. But still the US dominates in many, many ways other markets. So I think, yes, there will be a diversification away from the dollar, but it will be marginal diversification. And when you think of what's the biggest risk going forward in terms of currency markets, I don't think that for the dollar the risks come from the outside. I think it comes from within and from these aspects that I mentioned. And if the US addresses some of these issues and some of these directions of travel that I mentioned, I think that the US and the US dollar stands to do fairly well going forward. Maybe, yes, a little bit weaker in 2026. That's what markets are saying, and that's what market indicators are priced for. But I think that the US will still dominate for the next few years, the US dollar. Thank you.
Thank you, and I think that's a nice sort of ending spot here for our panel, kind of thinking forward about some of the issues and risks. So thank you very much to all of you for your thoughts and sharing your views, and thank you for your questions, and we'll now break for coffee. Thank you.
It was nice.
Thank you. Kind of jumped into some,
nice,
ad hoc.
So welcome, there we go, I can hear myself. Excellent. Welcome to the second panel of the day, which will today focus on trends in FX liquidity and price discovery. And I'm very pleased to have a great group of panelists with us today to discuss these topics. So I'm going to kick it over to them to quickly introduce themselves before jumping right in. But we can start, Chris.
Great, thanks, Dan. My name is Chris Chataway. I'm global head of EFX and voice trading at Goldman Sachs. I've been there for 25 years and spent my entire career in the FX market.
I'm Jeremy Smart. I run distribution for XTX Markets. We are a non-bank liquidity provider across multiple asset classes. I've been in the FX market since 1998, which is really quite frightening, isn't it?
Blaze Shepard. I head up FX at One Kronos. One Kronos, we're a venture-backed technology company. We build matching engines across capital markets that optimize for particular outcomes our customers want. We launched with a U.S. equities venue, and we're excited to launch a spot FX venue early next year.
I'm Simon Jones. I'm the head of FX product and liquidity at the London Stock Exchange Group. Worryingly, I've also started in 1998, but Jeremy and I did not go to school together. But yeah, I'm a 25-plus year veteran of the FX industry.
Great, thanks. So I'm going to kick it off with a theme that Anna mentioned in the keynote. So one of the things that makes the FX market so unique is, especially compared to other asset classes, that how decentralized it is and fragmentation of liquidity pools. I guess, why do we think that we see this trend continuing? And also, should we view that as a positive or a negative from a market structure perspective?
Sure, I guess I'll start with that. I think the fact that we've actually sort of seen more fragmentation and we've seen a move towards more bilateral liquidity provision demonstrates that it's a better thing for markets. And in fact, you see in other asset classes, and I'm sure Jeremy can speak to this, the equities market, for instance, is actually taking the playbook from FX and moving to a more fragmented, bespoke pools of liquidity, like trading in a way that's not as public and, quote, noisy as it used to be on public venues. So it's sort of worked to reduce market impact and exchange risk in a more mutually beneficial way. So I actually think the fragmentation has been a good thing, and I think it's going to be here to stay.
Yeah, I would agree with that. I think it's commercially driven reality, fragmentation. So what has happened is because FX is essentially, or spot FX anyhow, is an unregulated market, it moves to whichever is the best form of commercial transacting, particularly in a market which is so diverse in terms of market participants and extremely competitive. So it allows people to try to say, my flow is better than the average, ergo, I will try and find an alternative way to trade, which is better for me to trade. And that suits both parties within the transaction, both the liquidity provider and the consumer. And that's really why we've seen what we've seen. And the fragmentation, and I've said this a few times on various panels, but the fragmentation, people will tend to view it as a fragmentation in terms of trading venues, but that's not really how I see it. It's trading venues, yes, of course that has happened, and you've seen the growth of trading venues over years, but also fragmentation by protocol. So today we see all these different protocols within the market, from firm to last look to streaming to RFQ to disclosed, semi-disclosed to undisclosed, et cetera, and every client trying to find what is the best way for me to execute my business. If you just think about an exchange-traded product, very, very simply, when things trade on an all-to-all CLOB exchange, roughly, half of the market participants are subsidizing the other half of the market participants, roughly. And when the people who are the subsidizers realize that they are subsidizers and find that there's a better way for them to be able to execute, they will try and migrate to that. And if they have the ability to do that, as they do in FX, they will take that opportunity.
Actually, one thing you said, I think the word fragmentation has a bit of a negative connotation, and your point about the different channels of execution, different ways of trading, it's actually like customization of liquidity. So there's a lot of customization of liquidity so that you can provide the best price to your client in whatever conditions that might be.
I would add to that too. There's a couple things around, when you're talking about fragmentation, what kind of fragmentation is it? Is it customization like you're talking about, or is it rules where you are barred from accessing a particular area because they have defined that you cannot participate there? And those are two very different things. And I think that now, it seems like from sitting in my seat, it's a bit of a moot point because the technology has evolved now to a point where navigating these venues and these liquidity sources via smart order routing technology is not a tremendous operational lift anymore, the way it may have been 5-10 years ago. That still doesn't answer if you are not allowed to access some of it, then that's another conversation to be had. But I think the other thing I would say to this is to Chris's point is FX really fragmented? Because if we look at the U.S. equities market, just for example, there's 50 odd places where you can trade U.S. equities. And then within those, there's multiple different forms of fragmentation going on. Even us, little one Kronos, who's 50 basis points of the U.S. equities market, we're setting up 10 to 15 private rooms a month in the U.S. equities market. And we're still a very small player. So as long as you can navigate it, it's not necessarily that bad of a thing.
I don't disagree with that, Blaise, and that's definitely true. But if you look at equity markets in the US today, roughly 50% of equities trades off exchange and 50% trades on exchange. In FX, the amount that's traded on exchange I mean, there's no really truly available public data. But
Yeah.
I'm going to say 5% or less.
Yeah.
And I don't think I would get a lot of disagreement.
And there's no
from the
last
panel.
look in equities, right? Back to your protocol.
Yeah, and to the point Chris was making, this is definitely a process which is happening in equities, and it's happening really quite fast. So the process of people trying to find better ways to execute for their flow and their quality of flow is happening very, very rapidly in equities, and we're a part of that. We obviously support private rooms and stuff in equities. I don't want to get too deeply into equities, but you know that process is happening, and it's happening apace. And in some respects, it's not immediately clear to me what the brakes will be on that, and that might be an issue for regulators within equities. I don't know. We'll see over time whether they have an issue with that or not. At the moment, it doesn't look like they do.
This is quite a spot-centric view.
Agreed.
Spot-centric, G10-centric, right? And the reason for that is ease of setting up a venue, right? It's not hard. There's no like regulatory requirement. There's something like 35 venues that are registered on the GFXE website, all of which provide spot. If you talk about forwards, it's limited to 4 venues, 5 venues maybe. And so I'm not entirely convinced that there's fragmentation has been ubiquitous across every part of the FX landscape. And it's regulation. The unregulated part of the market has resulted in multiple options, competition across the board, and where you've got regulated products, it's very restrictive.
I'm not sure it's the regulation that causes that to happen. I think it's credit. And I think credit risk remains the biggest single friction, bilateral credit risk remains the biggest single friction to market structure change for particularly, obviously, sort of corporates and real money, et cetera, which is an area which really cannot be accessed by, for example, non-bank liquidity providers typically.
But the hurdles are cost, right? In that, in order to get into that spot business, it's cheap, it's just a technology play. But to get into provision of forwards or swaps, certainly in Europe, there is a high hurdle from a the cost to get into that business. You could still facilitate bilateral liquidity. That isn't, it's not restricted to certain venues. So I agree, credit is a much bigger problem. But for this particular, the fragmentation argument, it's very fragmented. It creates spot, which creates lots of choice. But in other assets within FX, it's quite restrictive.
I mean, there's not a lot of like primary market trading in forwards, is there? So you can argue that it's already pretty fragmented forwards. It's fragmented into a particular market structure that happens to fit with the bilateral credit structure of the market. I mean, there isn't an options club. Well, I mean, there might be. I'm sorry if I did disservice to Digital Vega, but like, it's not a significant, part of the market as of yet. Similar in swaps. I know there's a panel on that later, so I don't want to steal their thunder. But like, we don't have that yet, right? A central limit order book for swaps, for example. So I would say it is fragmented. It's just fragmented in a very different way to spot, and I take your point on that. So.
Yeah. Despite the challenges in credit bilateral, do we still see a trend in further electronification on non-spot? So spot swaps and forwards, options. Has that trend been moving more towards e-trading?
I mean, very much so. For a long time, the swaps market has been starved of any innovation, right? And it's primarily voice broker driven. We operate one central order book for swaps, and it hadn't been invested in for almost 2 decades. But there's lots of signals within the market from. There are firms that are focused on the point Jeremy makes about credit distribution. Firms like Cobalt, you will see there are multiple venues now set up to address the swaps club issue. Streaming swaps is now something offered by more than 4 or 5 different venues. So, and also, Chris will comment more on this, but the primary market makers in swaps are investing in the infrastructure to distribute prices beyond just direct to the customer, but also as a means of hedging. So yeah, I'm quite bullish on the change. Chris, don't
well, I was going to say, we've been at it for 20 plus years in terms of, creating more efficiency in the swaps market. Why is it going to be 2026 and we still haven't really moved the needle?
But like the efficiency that you describe has all been driven towards dealer to client parts of the market, right? Spreads are never better. The time of day you can access swaps liquidity has never been better. It's all been put in that direction. What I'm suggesting is that the time has come where, well, what you do on your end in terms of risk management has a higher algo quant-based activity than it did 10 years ago, but you still manually shout into a microphone in order to hedge. It's just not, I just don't see in 10 years' time we sat here again saying, oh, the FX market is the one market in the world, you still do that.
I would say we don't shout into the microphone at all.
Whisper?
What's that?
Whisper?
we whisper, shout. We don't do any of that. In fact, we don't. Like our reliance on D2D brokers is probably the lowest that it's been ever in its history. And what we rely on, and this is very similar, has analogies in the spot market, is we rely on our franchise, our client franchise, right? So dealing with another dealer doesn't move the needle on the coalition or wallet share with important clients. But if I'm axed in 1 month euros and dealing with an institutional client, now I've satisfied my coalition goals, and I've also made a client happy, and I've monetized some spread versus paying brokerage and spread away to one of the D2D brokers.
It does kind of suggest that all the positions that you get into are given to you, and the ones that you want, you hold on to. There must be some proactive position.
Well, yeah, that's around the inventory skewing, right? So like positions that we want, we'll skew into, and yeah, there is some degree of, I suppose, toxic risk or risk we don't want that needs to be recycled. And there is, yeah.
But even if that's just 10% of the market, at $4 trillion, that's an attractive amount for vendors to chase.
That's true. And so we've talked about swaps and forwards. On futures, we often hear that that's a key point for the spot market from a price discovery perspective. Why do we think that is? Is it different players? Is it a speed thing? Is it the exchange lit?
I mean, I'm bound to say that I think that the FX market has had a fairly seismic shift over the last sort of 10 to 15 years, really, where the primary markets, meaning EBS, Reuters matching, and the CME, have really, and trading there has become more and more dominated by non-bank players such as ourselves. The secondary market, the piece which faces clients and so on, is very much dominated by the banks. I would say, not an advert, but XTX is probably the only one that has successfully navigated sort of straddling both markets. And generally speaking, if anything, people are reverting back to sort of more standard position of non-banks really trading very heavily on the primaries and the secondary market really being owned by the banks and driving internalization to try and not stay away from the primary markets, but touch the primary markets as little as probably possible. The move to futures, I think, is partly an aspect, a sort of function of that change to some degree, because obviously there are many more active non-banks in the futures market than in the cash spot market. But the other thing that just definitely precipitated the change was speed of market data and contract size, right? And so it becomes much easier to create prices and to create price formation in smaller ticket sizes and with much faster market data. So the simple fact is that the primary spot markets, and I'm sure Simon's going to comment in a minute, but were somewhat late to the party in terms of reducing over time the market data increments. And so because market data increments were slow to change and tick size was slow to change when it should have changed and should have got tighter, mostly tighter, not completely all tighter in all markets, actually wider in some markets, but should have got tighter, particularly across things like Commonwealth pairs and things like that. The market shifted over to the CME for primary price formation, and it's not really going back, right?
And importantly, contract size as well.
And contract size, which is critical. And I think there was a comment made on the previous panel about, trade sizes potentially going smaller and smaller and things like that. And I sort of do tend to agree with that. I think that's a general phenomenon that we've seen over a period of time. They're not really going a lot smaller now, but they definitely are sort of more in the, I suppose, closer to $500,000 now rather than, say, $1 million of 10 years ago, something like that. So, but the link between futures and cash markets is incredibly important, and FX Link is an incredibly important part of that component. And I thought it was really interesting when we talked about in the first panel, and they were talking about how resilient the FX market is, and we talked about sort of intense levels of volatility, in April, vol got to what, like a 10 handle, something like that? I mean, that used to be like normal. That was like normal market vol, right? It's only that we've gotten used to this newer kind of norm at like 6 handle on FX vol, right? 10 was not an extreme level at all. I don't think we really tested the resilience of FX markets there. The time when we test the resilience of FX markets will be when there is a real crisis. Now, what form that crisis takes is really hard to know, because the funny thing about crises is they're usually quite different to the ones that we've seen before, because people are quite well geared up for those sorts of things. People are now actually very well geared up for the SNB type scenarios and things like that. I think, in terms of people aren't going to get run over in the same way. The way they manage their risk and stuff is very different to how it was in 2015. So crisis may look very different, but either way, where you're talking about, some kind of multiple sigma event move in a currency, that link between futures and cash is going to get very severely tested. And particularly, you've got a futures market which is heavily regulated, does have, for example, limit up, limit down constraints, etc., although albeit wider than they used to be, and a cash market which we've gotten very used to being continuous, right? But will it still be continuous if, really in the end, and this is the point which I'm sure, Chris will debate with me, but, in the end, when banks are providing the liquidity to that secondary market, but we see that during crisis situations and during times of heightened volatility, a lot of business moves back to the primary market. And if that primary market, becomes kind of less accessible because it's really transacting mostly in the futures market and that link breaks, then that could be a real point of failure. I'm not saying, by the way, I think it's going to happen by any stretch of imagination, but I do think that's a risk.
We had a short example of this, right, the day after Thanksgiving, with the CME down. So I guess that's a good case study. How did you see that play out without kind of that futures market active?
It was importantly also month end as well. And so it was actually quite a volatile day. I think it was actually the interest rate futures that were more impactful to the market than it was FX. FX, I mean, I kind of take the other side of what Jeremy says. I think FX is an extremely well-functioning market, and the number of shocks that we've witnessed, and just even in the last 10 years, but you can go back 20 years, in all of those circumstances, like the principal parts of the market worked. CLS worked, settlement worked, right? Risk intermediation occurred, albeit at wider prices, and it's more volatile. But the critical functionality being the settlement and the risk intermediation, all those things worked. I think that's what's important. I mean, it's going to be more expensive to trade, right? But that's a function. That's an artifact of the volatility, right?
I mean, I'm not sure if the futures market disappeared tomorrow, that's the end of FX market making capability. But I think the other way around might not be quite as palatable for everybody. I mean, I actually agree with your assessment of the ecosystem, but what it does imply that the primary markets are dominated by yourselves and other non-bank market makers, and when they disappear, the banks are incapable of making a price. I don't know if I agree with that. I don't know. That's
I didn't say that.
I would hope so.
But you do imply that.
Said, though.
No, but you do imply that at the top layer, there's a market data availability that comes from the CME, which is formative in making other markets, right? Of which you say you dominate, which I agree, you and other peers. But if that disappears, I don't know. It's like its own mini ecosystem, extracted out for the FX market. Within months, it returns to normal.
Possibly, but I mean that will be the test, and that will be what we'll see. But what we do see during situations of much heightened volatility or kind of crises scenarios, is that the internalization which banks run falls away pretty rapidly because the market is fundamentally one unidirectional at that point, and requires therefore, and what we see is primary market volumes going up very significantly. Now you will know, Simon, that is fundamentally made up of banks passively market making onto those markets, and then that liquidity being actively taken by non-banks, right?
Yes.
So that's the scenario. So in the event that you have no non-banks or non-banks unable to, want to or to be a market participant in taking that liquidity, then you have the potential for something much closer to a liquidity kind of crisis.
It would also be very bad for volumes.
Sorry?
It would also be very bad for volumes.
It'd be very bad for your volumes, yeah.
You had mentioned, obviously, one big major theme of non-bank liquidity providers becoming more active in liquidity provision, including from firms like yourself. Taking a step back, what do you think that implication has, if any, on the markets landscape? Sort of the move, I think it was 4 out of the top 10 of recent Euro money were non-banks, for market
Actually,
share.
can I add to your question? Is it easier for you to grow now or harder?
To grow on the client side or on the?
I guess in FX period.
I mean, in
Because
FX
it's credit
period, I
primaries.
would say we're relatively stable,
Right.
kind of a relatively static part of our portfolio. I do think one of the issues that does exist for the market is that we tend to view, so in this whole conversation we've talked about non-banks as though it's a ubiquitous sort of or homogeneous group of market participants, which is not the case at all. And actually, I think the diversity of that is getting broader, not narrower. So I used to think that all non-banks would actually end up falling down a similar kind of pathway and trajectory. But today what we see is actually people moving in very, very different trajectories. And, speaking a little bit, I suppose, for ourselves, as we move into the world of sort of looking more and more at sort of deep learning and the applications of deep learning in market making and taking across multiple asset classes, is that you can see that, typically speaking, and you can see this from market data, that the yields and the amount of profit that you can make is much, much higher in asset classes outside of FX. And that leaves you to wondering, will non-banks continue to really focus on FX and actually build FX-specific market making and taking capabilities, et cetera, or will they actually say, my investment case for making prices in corporate credit, in equities, in government bonds, in commodities, et cetera, is actually much, much higher. So I'm really going to focus pretty much all my efforts on that. And actually FX is almost I don't want to say byproduct because that would be the wrong characterization of it, but it's almost a sort of slightly secondary thing.
But would that be true if you had access to every FX client? Or a standard that is as high for like a JP Morgan or something?
Goldman Sachs.
Or Goldman Sachs, of course.
Yeah, I mean, it's a good question. I mean, in equities where you do have access to pretty much all clients, you just have to look at equities and say the yields are just much higher. The yields, obviously, in corporate FX, I don't want to get too deep into this because I know, it's a sort of different world to my world, but, I think we can all say that the yields in corporate FX are very high and probably very attractive to people, right? But there are many, many obstacles to that ever happening.
The structure of FX doesn't allow you to get to the full range of customers.
Correct.
And yet, you've been able to step into a market which has 50 venues and doing extremely well. I really can't balance that up. Although you're really good, right?
Why?
Well, because there's so many venues and there's so many actors that suggest efficiency to me, and yet there's been enough inefficiency for you to build a business super quick in equities. What was the magic?
No, I think you're missing a couple points. So one is that I don't want this to become an equities debate, sorry, so okay. I'll just try and stay away from it a little bit, but like...
We can pull it back to the lessons that we can...
One of the big differences as a market maker in FX is that, and I had this conversation with Chris just before we sort of came on, is that like, when I look at markouts, and we're all quite familiar with markouts these days, right? But when I look at markouts in FX, they kind of, really what I'm doing is classifying them by sort of color of ski slope, right? So you've got kind of green, which we kind of view as like, that's pretty good flow actually, but it's still directional, right? And then sort of, what comes next? Blue, isn't it? Yeah, and then red and then black, right? And black is probably Japanese retail or something like that, right? Which goes through zero in a second or 2 seconds or whatever, right? In equities, the curves go the other way, right? So the difference is, for example, in equities, you've got a lot of people who are not really in the, buying because the market's going up, selling because the market's going down. They have a much longer term view of the market. Whereas in FX, people are much shorter term view.
But don't you have a negative spread revenue because you're paying for the flow?
You can even have a negative, spread. I mean, we do a lot of business in equities at midpoint. I mean, you have to determine whether you think the exchange mid is the right mid or not to determine whether you're a negative spread country. But like mid, or near point near touch for a number of clients that we price. I'd never do that in FX.
Yeah. If I could just touch on the non-bank point, though, I think you're right, though, about the diversity of non-banks in foreign exchange. There are a few non-banks that operate on exchange, and they're very good at it, and that number is not increasing, it's probably getting smaller. And what we've seen a ton of growth is I mean, non-bank is, again, a very broad term, but we've seen a lot of pod shops and systematic shops that are trading bilaterally over API with primarily banks, perhaps with XTX as well. And that's providing a really efficient mechanism for us to recycle risk.
Yeah, that's a really good point. And that line between whether they are market makers or takers is a very kind of fine one, right? And we always used to talk about buy side, sell side merging and blurring and whatnot. That has really happened. And Chris will know, as we do, because we run a not dissimilar model in the end in FX, right? Which is that really, if you really want to internalize flow, you need to have a franchise which touches retail brokers and systematic funds and pod shops, because really those are the guys that when you show them skew, they trade. You cause them to trade rather than happening to run into some trade if you're pricing a smaller bank or.
Well, I think what differentiates non-bank from bank, though, is the diversity of our franchise, right? So
absolutely.
The fact that we have the corporates and the asset managers and the hedge funds and the retail, right? By having an uncorrelated set of clients, it allows you to operate and operate perhaps with more scale than it might if you're just a non-bank.
Yeah, I think it can do. I do think, though, that those, as long as you have a franchise which touches those groups who really trade because you show them skew, then you can run a pretty successful internalization model, I think. I think corporates don't react massively to skew, do they? Not massively.
No, but I guess what I'd say, though, in that sense, is the corporates give you inventory that you're then recycling with other clients, and that's building sort of market share and mind share.
And quite a lot of markup.
It seems like it just comes down to what's the basket of goods and services that you offer the end client. And those vary, and that diversification of objectives adds a lot of value in the long run amongst both banks and non-banks. That's why we tend to see it as a pretty symbiotic relationship.
Yeah.
They both need to exist. And the way that we look at it is it kind of just comes down to, like I said, what's the basket of goods and services that the end client's looking to consume? And that can be a spot price right now, but it can also be a lot of things of balance sheet, lending, all the other stuff that Goldman Sachs is very good at.
So what would you say the comparative advantages of each? The non-banks like speed and spreads, and banks are kind of client-based and reach, or like how would you kind of summarize their comparative advantages for that relationship to work well?
I would say breadth of product for sure. The extension of credit and other goods and services. I think the spreads can be equally, if not more, competitive, and the perhaps size of risk that we're willing to warehouse is probably on the margin deeper and larger than what non-banks would provide.
Like, how do you view them? Do you view them as they're a good source of like wholesale liquidity that we can, or is it?
I mean, with credit to Jeremy and XTX, I think they're different from most of the non-banks. There aren't many non-banks that really swim upstream and compete directly with, for our client flow. I think probably XTX is maybe the only one that's done that with some degree of success. The rest of them are just sort of happily on exchange market making, and they probably market making a bunch of other asset classes, and FX is just a copy and paste from their futures, commodities, and rates strategies. And they sort of quite happily live in that ecosystem. But I think the wholesale foreign exchange banks and maybe XTX are competing for the lion's share of the institutional wallet.
I guess we have seen some kind of penetration from people like Optiva in the options space to some degree as well, just to be fair to some of the non-banks and stuff,
Can I ask these guys a question? When the CME went down, did you observe anything in terms of surprises that you saw of, who continued trading and who didn't? Who was really reliant on the CME in terms of just from your seat of what you viewed?
We had a slight over-reliance, and I'd say probably, maybe even like you could call it a software bug, with our NDF pricing. So our NDF pricing sort of had some certain assumptions around EBS being there, which they are an important market in NDFs, but they're not the only market
And actually, there was a point that you made earlier, Simon, that I wanted to contrast. You said G10. Like, I actually would say all deliverable and even the NDF markets are highly electronic and very efficient in foreign exchange. And we've seen a lot of evolution or innovation, I should say, in the NDF space. There's multiple different venues that you can trade on. And we had a little bit of an over-reliance on EBS instead of falling back to the numerous other venues where we could have traded.
There's still like significant tiers among the currency pairs within those bands, right? I mean, of liquidity.
Yeah, there are.
I guess my point is that from a primary market perspective, there are still markets where the primary is central to everything, and they're generally markets that are tied closer to central bank and regulation. India, Vietnam, Thailand, Turkey, right? These are still thriving primaries in the traditional sense, but the fragmentation is sterling, Aussie, euro, yen, right? That's the distinction I want to make.
Blaise, there was one question that you brought up that I think it was good to maybe end with before some Q&A, but specifically, how do liquidity providers meet the needs of certain asset managers that are more FX native and alpha seeking? And I know it prompted some conversation before that, curious to hear your thoughts on.
Yeah, I mean, I think when we have discussions with people that trade FX for alpha versus people that trade FX to hedge other things, the conversation is night and day, but those conversations are starting to converge. And what I mean by that is folks that are your traditional hedging FX clients are now more focused on things like markouts and things like information leakage. And they were before, but it's becoming more and more of a front and center discussion. And I think one of the things that we're noticing from our conversations is there is a lot more of multi-asset class trading going on at these firms. And I think what we're seeing is somebody comes in that used to run equities trading, and now they run all of macro. And they get into the FX department and they look at it and it's like, okay, so you just take in a bunch of dealer feeds and that's it? And it's like, okay, well, if that's 100% of the business now, we need to have some kind of auditable, standardized benchmark that we're using across this portfolio. And I think what the long-term effect of that is, that I think is one of the reasons that's fueling a tailwind in FX algo adoption. Is it's not going to go from 0 to 100, but I think when people are looking at it and saying, well, right now it's 0, it should probably be like at least 10, just so we have some kind of data set to look at. And I think for the folks in this room and the folks on this stage, like if you're providing an outcome to somebody that supports that benchmark, whether that be in terms of quality of pricing, markouts, inventory that you're showing them, you stand to win in the new regime. Like, you stand to benefit from that. That's one side of the coin. And then the other side is folks that are FX native, alpha seeking. The conversation is much more on how do the transactions costs and the execution quality fit into my overall strategy? And what's the research around, can I deploy this strategy, or do the transactions costs, whether implicit or explicit, erode all of my alpha before I can even execute on it? And I think that's where a lot of the discussions around venue design and all of that comes up.
Yeah, I agree with that. I mean, actually, and look, we're massive supporters of transparency of post-market data and of post-trade data and stuff. We're big supporters of things like TradeFeeder in the algo space, creating a peer universe to help clients get over the statistical sample size issue, and happy to do that actually on streaming and RFQ as well, and whatever. We were very happy to put our names to that. We're also very happy, by the way, to say to clients, we don't use their name or their identity in any form of hedging or trading activity. We put that in our legal contract, et cetera, et cetera. But I think the information leakage point is a really, really good one. And it's interesting in equities where we have this equivalent streaming price concept, but of course you're not actually, in US equities, I don't know if you know, but you're not allowed to show a price. It's quite a strange artifact, but you show side and size, but not price. You imply a price point by saying this is a mid feed or it's a far touch feed or whatever. It's a bit weird, but it is what it is. But in that world, we're actually very concerned about information leakage ourselves. And we're very concerned about information leakage ourselves within FX as well. And within FX, it's actually quite difficult to police and stop real information leakage. I can clearly do watermarking type things, and I'm sure Chris does the same thing. And you look to see whether your market data changes are replayed into market data that you see from public venues. What you can't see is when somebody is using your price prediction capability to say, I'm going to pull my orders from the market, or I'm going to change my trading activity off the back of that. That's much harder to pull out. Equities market design, because of this, the construct and the sheer amount of market data, because you're talking about 6,500 instruments, not 40 or 30, right, makes that much harder. So typically, we are using venues to intermediate our trading in equities, precisely partly to stop information leakage. Partly it's a facilitation thing, and then partly it's to stop information leakage, because I don't want to show my alpha to a systematic hedge fund any more than they want to show me theirs, right? And so that actually venue intermediated activity there can be very, very positive. The problem in FX is intermediating and creating more transaction cost, partly to your point, is a problem and an issue. And that's why people typically try to go direct, because they're trying to really minimize the cost point and maximize the efficiency of the trading. I don't know if you agree with that, Chris?
Do you want to save some time for a couple questions if we can fit them in? Or we can go back to arguing about any other questions that we have listed as well.
No, I mean, you raise a good point around information leakage. It's something that we study extensively. We do some of the watermark A/B testing. But I'd say like a lot of times, it's as simple as, we have a lot of bilateral relationships. It's as simple as asking the client.
Yeah, of course.
It's as simple as having like trust and saying like, this is the price that we can show you, and if you can attest that you're running an independent alpha-seeking FX strategy that doesn't use the skew information against us, then we're happy to at least try sending you a skew.
Hello, thanks to the panel. I'm Richard Levitch from NYU. I was here a year ago, and a different set of panelists named only two primary markets, EBS and Reuters matching. And today, one of the panelists, Jeremy, I think, added CME to the list. So one question would be whether you're in agreement that there are three primary markets for FX and not two. And then to follow on, we conventionally hear that price discovery happens in the primary market, but perhaps it's a lamppost problem. We look to the primary markets because that's a place where we can look to see actual data, and a guess might be that 80%, 85% of trades, FX trades, happen outside of the primary markets. So a question would be, for these trades that happen outside of the primary markets, it's reasonable to think they contain information about fundamental flows. So second question would be, where is that information likely to be reflected initially? Perhaps in the CME, perhaps in EBS or Reuters. Do you have any view on where that additional non-primary market trading data information gets reflected in price?
So to your question on the I don't like using the word primary market. It sort of assumes that they're like the gold standard for liquidity. And so they're a market of many, which has certain characteristics that are different perhaps from the others. I would put CME in that category. It's a little bit different from the cash markets because it's a futures contract and all the other sort of technical, mechanical differences of that market. But yeah, it acts like one of these important markets, shall we say. So those are the three important markets, not primary markets. And then your second question around where if the client alpha, where is it getting reflected? Well, if it's not trading on the primary market, it's probably being intermediated by a bank. And the bank is then using that inventory. Either they had inventory that they were skewing into, and so it's sort of like, it suits because it's risk reducing to us. If it's risk increasing, then it may come out actually as a negative trade for us. And so we'll see that, oh, we're not able to profitably provide liquidity to this client because they have alpha. And so over time, we'll lose money, and that'll be problematic, and we'll have to widen our spread. But if it's risk reducing, it's, for the most part, seen as like accretive to the bank because it's, sort of monetizing some spread, and we're able to run a business. And then, 30, 60, 90 seconds onward, we don't really, we don't care what the sort of horizon of that alpha is so long as it doesn't overlap with our own risk management horizon. So if a hedge fund has sort of alpha on the order of 10, 15, 20 minutes, right, that alpha will be, I guess it'll be reflected over that period of time, but it'll be unbeknownst to the institutional market maker that was showing that risk.
There's no FX tape, right? So, and we won't have a whole discussion about FX tape. So you're not going to see the trade prints and so on and so forth. I would go much higher than your 85.15. By the way, I would say it's 95.5 that's happening. I mean, that's just my view. But the where you could see it potentially is if you're a client, you can see it. If you're a decent client and you're able to get all of the skewed prices from all of the major liquidity providers, that composite price, and in particular the sort of aggregate demand and supply that you can see at the midpoint price that you create in your own stack of liquidity, will give you a very good reflection, I think, of where the market sentiment is in a way, right? And where market positioning is. That's a pretty good indication of that, I would say. But to get that, you've got to be a pretty good client to get everyone's alpha like that.
All right. And with that, I know we're up against time, but if you could all join me in thanking our panelists for today.
Great. Thanks, Chris.
Good job. I will step up my voice then. So, hello, good morning to everyone. I am Gerardo Garcia. I'm the General Director of Operations at Banco de Mexico, and I'm also the Global Foreign Exchange Committee Chair, and I'm delighted to be here with you today, and I'm honored to chair this panel. Let me lay some ground on today's discussion, and let me begin by giving you some context and taking you back in time to 2017. The introduction of the FX Global Code was a response to concerns regarding the integrity of the wholesale FX market, and mostly about notable cases that exposed instances of inappropriate information sharing, execution practices, and collusive behavior in dealer-to-dealer and dealer-to-client interactions. Such cases created fault lines in the confidence in what had been considered up to that point the most efficient market in the world. The perception that FX markets lacked a consistent integrity framework became a concern. In response, the BIS Markets Committee and a coalition of central banks and private sector participants began drafting the code in 2015. And the aim was to articulate a set of principles to promote best practice in different areas, such as governance, transparency, execution, risk management, and information handling. As you know, the first version of the code was published in 2017, and has been updated twice since then, in 2021 and 2024, so that we can make sure that the code remains fit for purpose. It represents a global, voluntary, principle-based framework of best practice that covers the full FX life cycle. Its strength derives from the breadth of its collaborators. In fact, it was banks, platforms, trading venues, corporates, asset managers, and infrastructure providers that had a seat at the table and that keep having a seat at the table to draft the code. The continuous commitment to a broad consultation has helped the code reflect real-world practices and evolves alongside the market. Since its launch, the FX Global Code has contributed to improving market conduct. One could argue that we have observed greater discipline around information sharing, clearer governance standards, and more and better documentation of trading. Trading venues have increasingly published standardized disclosures, and banks and liquidity providers have strengthened surveillance, refined their internal guidance on order handling and execution, and have built in more robust governance processes. I think it is safe to assume that market participants have seen an improvement in trust. In some, the code has helped rebuild credibility in FX markets where lapses have previously undermined confidence. But when all is said and done, a gap persists. The relative participation and engagement of the buy-side entities with the code lags behind. Although the code is designed for all market participants and many of the principles are actually very relevant for asset managers, hedge funds, pension funds, and corporates, the adoption rate among these segments remains modest. So I firmly believe that with a broader adherence to the code, it would fully deliver on its vision of unified, consistent set of principles across the entire FX network. Stronger buy-side adherence would further enhance the credibility and positive impact of the code. So a way of understanding the buy-side engagement and their representation is precisely by learning more from buy-side participants who already have opted to adopt the code. So the aim of this panel and these questions is precisely to explore some of the key considerations they have had and that eventually led them to adhere with the code. So with this context, let me introduce our distinguished panelists, and I will start from left to right. So first, Tyler Wellinsik is the Global Head of Market Structure at BlackRock, world's largest asset manager firm. And at BlackRock, Tyler and her team are currently responsible for advocating for key reforms in financial markets with regulators. She has previously worked at Barclays in several senior roles across different asset classes. Then Tom Gentile. Tom, Director of Trading at Crabel Capital, an asset management firm that builds on research and technology to develop quantitative systematic trading strategies. Tom has spent around 2 decades helping the firm's evolution in automated and algorithmic FX execution and expanding the firm's trading platform. Tom has previous experience in the commercial banking industry in the US and in Asia. Pleasure to have you, Tom. Likewise, Tyler. And Ankit Sani, Head of FX at Element Capital, an alternative investment manager with a focus on global macro, systematic, and relative value strategies. Ankit is responsible for all the interaction of the firm with FX markets and for conducting analysis on macroeconomic themes and capital flows. He previously worked at Exante Data, conducting research at Prolog Capital, defining investment strategies, and at Nomura, doing macro research. So let me start now with the questions, and for all of you three. So what do you think is the strategic value of that your institution sees in adhering to the FX Global Code? So basically, what is the motivation of your firm to adhere to the FX Global Code? Tyler, if I may start with you.
Of course, and thanks so much for having me. So as a fiduciary at BlackRock, ultimately we're a client service organization, and we're trying to achieve the best possible outcomes for our clients when we're engaging in markets. And we see a huge amount of value in the code in promoting what we see as frictionless markets over time. The code does a great job of creating a clear expectation across all participants in the ecosystem as to what good looks like. And that gives us a lot of confidence around the consistency of pricing and execution that we're getting from our liquidity providers. It's also been really helpful for us on other parts of our workflow and sort of this continuous improvement process around our control frameworks, particularly when we look at things like settlement and operational risk.
Tom?
Yeah, likewise, it's more about making markets more efficient, and the more efficient markets function, then we'll be able to execute our business better. And generally, I think that the more dialogue that we have on this topic, which is facilitated by this framework, and thanks very much to the New York Fed for organizing this forum so that we could have more dialogue on this topic, and just institutionalizing these best practices, I think is going to make the market better. Because when you look at the panel that was up here just before us, you add the ages all together, they're older than the United States. So I think that when you take away that, perhaps that intimate knowledge that's been garnered for why the framework was created in the first place. People don't know, the younger folks don't know about the S&B or other things that were happening, maybe first order, that made us get this together. Sure. And so whenever we take that into our institution, we say, well, here's everything that you should be thinking about. And if everybody were to do that, or even know that those things were out there, it just makes the market better. And it's a very sort of like makes us participate in the market a little bit more efficiently.
Thank you. Ankit?
I would echo most of what Tyler and Tom have said. For us as well, as a firm, we're very active in OTC markets, so FX and rates are a big part of what we do. We understand that for OTC markets, there's obviously like laws and rules and regulations, but market norms are very important as well. And for market norms, there's often like a collective action type problem. There isn't an incentive for one particular actor to act a particular way until it becomes a norm in the market overall. And I think the code does a great job of standardizing, codifying these norms, and getting us to like a reasonable starting point. Like we think of where the code is. We think of it very much as you do as well, as like a living document. We think that there's, so it's a very good start to where we've gotten to. And we think there's like a lot of other areas in the FX market over time where we can actually, I'm sure we'll get to this in the course of this panel, that there's other areas in the market where the market can actually be made more efficient and more robust and so forth. And so for us, we want to contribute to that. We want to contribute to how things are right now. We want to contribute to making things better over time. So for us, like that's the objective.
Okay. So before we go into the things that may happen going forward in terms of the code, let me go back just to see what is the value of the code in terms of driving the interaction with clients. And maybe you, Tyler, can tell us what important it is to just promote the code with clients, and maybe whether it has a signaling effect, particularly in your role as a fiduciary for many of your clients.
Yeah, absolutely. As I mentioned at the beginning, we ultimately exist to serve our clients, and we take that very seriously. And the code has been really invaluable in terms of how it impacts our client engagement model. For example, it is definitely not unusual and growing that we see clients ask us about our code adherence as part of the RFP process, and we welcome that. We think it's a good question. We think that more asset owners should be asking their fund managers about this. Even for clients that don't expressly ask us about code adherence, as you mentioned, it has great signaling value that we are committed to engaging in the markets with a certain level of professionalism, that we support this evolution towards safe, efficient markets, and that we are committed to having the best workflows where applicable to us on the buy side.
Let me ask you how important the code is for your assessment of your counterparties and where do you trade. Is it important that your counterparties are adhered to the code, that they sign the code?
Yeah, it's definitely important. I mean, you spoke at the beginning about the history of the code and its background around some challenges on the sell side. I think as a result, liquidity providers have adhered. So the scenario of liquidity providers not adhering, I'm not aware of that being a problem. But I think if there were a scenario where someone hadn't, or there's a service provider that's new, I think that would absolutely give us pause in terms of our engagement.
Tom, let me go to the issue about whether it is hard to adopt the code or not, and maybe you can guide us through what the process was in terms of adopting the code and whether it meant some changes within the institution, or if it was already a way to formalize what the institution already did.
For us, it was just a way to formalize what we were already doing. When we looked at it closely, and we applied a little bit of AI to our, what we have as far as our rules of engagement and how we operate the business generally, those things lined up very tightly. And we've been in business for nearly 3 decades, and we're a pretty plain vanilla shop. So for us, we had the realization early on that we already were meeting all the criteria that someone in our position would need to be able to adopt the code. And it was really sort of like just when will we do it was the question, not so much how much inertia there was. There was very little inertia as far as like being able to get to the level where we could make that representation. So we were lucky in that regard, but it's just, the way that we run the business is very tight. And so Again, I think it's more of a selfish observation from our perspective in that if we say we're doing it, it becomes common knowledge. Other folks are going to take a look at their own operations and say, oh yeah, gee, we should probably write this down somewhere and make sure that we're following along with these best practices as defined by these people who've been around for a long time and maybe saw some bad things. And so it leads along a very straight line for us. And when we executed the documentation, it was really just very straightforward. And let's make sure that as we go forward as a business, everybody understands what these criteria are and just formalize it.
Thank you, Tom. Ankit, similar question. Was it easy to adopt the code, and did it have like any impact in terms of the organization, in terms of how you coordinate maybe front office, back office activities, trade, post-trade? Did it mean anything different?
Yeah, so I would fully agree with what Tom said as well. Like for our firm, the rules that, so on the sort of pre-trade stuff, the rules that our compliance department has set, I would say in almost all cases are generally stricter than the recommendations of the code.
Okay.
So it felt like a relatively low bar, and as far as that was concerned, I think some of the post-trade stuff, those are good suggestions and recommendations, but again, like we've been doing this for 20 years, we've refined our processes over that period, and I would say generally all the post-trade settlement, those types of recommendations, also certainly fully consistent with our standard operating procedures in the past. So there really wasn't, like, and then I guess like to the extent that there are things that have not been codified in our compliance manual, like anyone who reads the code can see that like any reasonable ethical person would be doing things that are pretty consistent with the code, I think. So it was not really a major challenge to say that, oh, we'll be restricted from doing this or that. It was very clear that none of our operating procedures needed to change.
And how do you make sure that the adoption at the high level of the organization permeates to the traders and to the people that are doing back office operation? How do you make sure that this really gets embedded in the organization?
Yeah, I mean, I think it's a little bit easier for us maybe than maybe, like let's say at BlackRock. Like we're a small firm. Like even when we were managing a large amount of capital, the number of people who are actively transacting with the FX market is like, let's say, a single-digit number of people. So the process for us was every single one of those people read through that document and essentially had a veto to say that, okay, like I don't like this principle or that principle. But like I said, that just did not come up because I think the principles are just very reasonable.
Tyler, similar question. How do you make sure that this goes all the level through the organization?
Yeah, I think it's probably somewhat similar, even though we are larger in sort of size and complexity. We do a lot of training to make sure that it's embedded in the culture of people who are actually touching the markets. In terms of processes, we've also found that it fits very neatly into frameworks we already have and things that we're already doing. Like I said at the beginning, it kind of helps us continuously check, like, are we going the right direction? Are there more things we need to do? Oh, we hadn't thought about this. Let's maybe do this a little bit better. So we really just sort of incorporated it into how we were already operating it, but it makes us, it gives you sort of this other thing to look at to make sure that you are on the right track in terms of how you're thinking about things.
And once you convey what the benefits are, have you been able to measure precisely like those benefits from adhering to the code? And how do you think that the code is probably complementing good practice in the market together with regulation? Can you comment on that, on whether you have seen like any tangible benefits?
I think it's hard to sort of disprove the negative, but we do feel very confident that it really sets a good industry standard of what good looks like, and that gives us confidence and a sense of consistency that we frankly need when interacting in the markets.
Do you think that the code complements well like regulation, or how do you think about it?
Yeah, I think that's a great question. At the risk of stating the obvious, FX markets are by definition the most global markets in the world. But I think what's also really interesting that was touched on a bit on the earlier panel, it's not just that they're so global with no single regulator or no single jurisdiction. They're also incredibly diverse and rich in terms of the products traded. You have highly liquid spot FX, and then you have much more complex options products. You have a huge plethora of protocols. And so with a product set like that, yes, regulation is incredibly important in setting standards for the market. But I think, again, with no single regulator, the industry-driven approach that the code has is so invaluable in terms of defining for all market participants what the right best practices are for engagement.
Okay. So what I said at the beginning is that the buy side is like lagging in the adoption in the code. So maybe, Tom, this question is for you. What do you think should be done for buy-side participants to increase the awareness of the code, but also the adoption of the code? What part do you think might be missing in terms of conveying a message, in terms of coordinating all the efforts so that buy-side continues to adhere to the global FX code?
Well, again, I think it just makes the market better if everybody who's a participant in the market, everybody, understands what deals. Like, how is the behavior of my counterparty supposed to be in this particular instance? And so when you read through the code, even though you're doing something that maybe you've never done before, you're fresh out of school or something, and you happen to be assigned to the Treasury Department of some corporate, and you're instructed to call up your bank, and do your trade. When you read through the code, you're like, well, gee, I've got a question. Maybe we should be dealing with more than one bank, or maybe we should be looking at it from a little bit different perspective. Things like that just benefit the institution. And, that just, from a fiduciary perspective, or however you want to think about your role in life, it's your job to be the best you can be at it. And so we're kind of lucky from my perspective. We've had a lot of resources to throw at the issues that we've come up with or come up against in how we engage the market. But I think more generally, whenever you start to write these things down, and it's a great document, there's been a lot of thought about exactly what each one of these elements is about and how to solve these issues and try to convey what the best practices are. I mean, there's no shortage of effort in that document, and it's a wonderful document to be able to put in front of anybody at whatever level of the spectrum they're on as far as their experience in the foreign exchange market. And so from that perspective, I would say it's very valuable for any institution, whoever is involved in the foreign exchange market, to understand, again, just understanding what deals is very important.
Okay. From your perspective, Ankit, it has been quite hard for us to engage and to even reach out to hedge funds, and certainly you stand out for having already adhered to the code. What do you think is also the missing piece for hedge funds in particular to be aware and to adopt the FX Global Code?
Yeah, I would say, so if you, excuse me, if you read the FX code, as a buy-side participant, it's very natural to think that this document is mostly not for me. Like, I think it becomes very clear that it's a document kind of primarily for the sell side, and I would say like mostly written by the sell side. I know there's been contributions from all investor types in the market, but the genesis, as you described for the code, is the background and the genesis is primarily a sell side thing. It also makes sense that the sell side is a little bit more concentrated. They have more legal resources to think about these problems more carefully, whereas the buy side is much more dispersed. Mm-hmm. So I feel like where the code is today, I sympathize with people on the buy side who feel like they don't have a huge amount to gain from signing up to the code, because first of all, their counterparties have already signed up, and also most of the code doesn't seem to be directed at them in a meaningful way. But that is, I think, where this point about it being a living document comes into play, where what is clear with the code is that the norms for the FX market are going to be set by the global FX code. And so over time, as these norms cover broader and broader sections of the market, they start to become more applicable for people in different parts of the market. Mm-hmm. And I think that process, I think it requires input from all stakeholders. I think it makes sense. I think what, what you guys are doing here is very valuable in that sense, is like bringing more people into the conversation to think about what the code should look such that it would become even more useful for those people as well. And so I think essentially like giving people a voice and creating incentives so that it's actually adding value to their day-to-day.
Okay, so this is where my opinion comes in, being not only the chair of the Global Foreign Exchange Committee, but also being myself a buy-side participant. When I first read the code, I was like, okay, maybe, yes, the origins of the code had to do with some wrongdoing from sell-side participants. But when I started reading the code and then I realized, okay, this is an excellent exercise to do some type of gap analysis and adopt best practice. And that's when I started looking at the value of the global FX code in terms of how we were set up, in terms of our governance, in terms of our execution. I really learned about execution. Central banks, we are not experts in FX trading. So just reading at the code, I started realizing how I was engaging with my counterparties in terms of the practices that they were doing with my trading. Like these practices are around last look, around pre-hedging, around if they were using an algorithm to trade with us, and I think that was very relevant. And then also comes the risk management side. And the risk management, it was very comprehensive in terms of not only operational risk, but also legal risk, in terms of settlement risk, in terms of how to address those issues. So I understand what you are saying, that this is, was meant in some way to cover the gaps that were coming from some type of participants, but when you look at the code and realize how much benefits you can gain from adhering and just to adopt best practice, I think that's one of the largest contributions of the code. And this is, as you know, coming from a central bank, that we are ourselves buy-side participants in the FX market. But let me continue with you, Ankit.
Sure.
And you said something at the beginning that meant to say that, okay, maybe there's something else that should be done in the code so that buy-side participants could be more engaged, or there are some opportunities to the code to maybe look at some other things that we haven't looked at. Would you mind elaborating on that? So going forward, where do you think that the code should look at and keep adding value?
Yeah, for sure. So, like I said, right, the buy-side, I think, is a very heterogeneous group in the aggregate. So different set of actors will be much more active in certain types of markets, and that could be the sort of specific currencies they trade or the specific types of derivatives they trade on those currencies. Mm-hmm. I would say for us, one major area where I think we have an above average share of activity is on derivatives, especially options and other exotic instruments. I would say it makes sense where the code is as it stands, but in terms of where it can get to, in terms of codifying some of the best practices in the options market, for example, with respect to how information sharing is handled, when we communicate a request for quote on an option, we are communicating a certain amount of information to our counterparties. Mm-hmm. I think it makes sense to think about how that can be codified in terms of how that information is used or shared. I think there's a lot, and this is like a very basic example, I think there's a lot that can be done in that space. So for us, like that's one area of focus. But my comment was much broader than that, mm-hmm. because I think like that's an area that's important to us, but for like a corporate that's active in less liquid markets, they'll care much more about some of the practices you were talking about, like pre-hedging and last look, and sort of ironing that out more closely together with the rest of the FX committee. I think those types of things would be extremely valuable as the code develops from here.
Okay. Tom, would you mind maybe addressing the same question? Do you think like there's any opportunity going forward for the code to be even stronger in terms of
Absolutely,
guidance?
absolutely. And I think that's, just to say it again, the dialogue is probably the most important point. And I think everybody's pretty open-minded in the foreign exchange industry. All the discussions we've had to date have been around, the market evolves. It doesn't just sit still and that's it. There's commercial interests that push it one direction or the other in particular. And so the more dialogue we have on how things should be happening, the better off we'll be, I think, as a market. And that's how I think about it. It's just if I were to, when I leave Crable Capital, I want to make sure that this institutionalization of the global code lives on, and making sure that, as an institution, we continue to adhere to that. And hopefully we'll have a voice in how that evolves as well, to your point. But I think there's a lot of participants who look at it and read it and say, oh, gee, this is really a sell-side thing. But when you start using words like pre-hedging and last look, somebody might say, gee, what even are those words? Like, what do those mean? And so that sort of sparks some interest around the tourists in the industry who aren't necessarily involved in it as deeply as we are. But when they come to learn about these things and they start to change their behavior as far as how they engage the market based on what's available, I think that's really like the biggest benefit of having that document out there. Without that document, what would we be doing? It's just like, it's a great document as a starting point to have those discussions. And I think that the more people who read it and the more dialogue we have about it, the better off we will be as a market.
Tyler?
Yeah, I'd agree with everything that you both have said. I think to emphasize it, the fact that it's living is so critical because it allows the document and the positions to grow as markets grow and change over time. There was great discussion earlier today about innovations happening in the market. I'm guessing some of those will lead to things that we haven't contemplated in the code before. So the other thing I would say is, in the absence of something that all industry participants lean into and continuously work to guide us in terms of what good looks like, I think it does create the risk, particularly in the environment we're in now with more fragmentation politically and from regulators, that you do see someone else step into potentially an area that maybe creates some fragmentation or different approaches to certain topics. So I think it's all the more reason to commit to this. And if you're don't understand it or don't feel it addresses things that are relevant to your firm, it's as you said, it's a very open community. There's room to have a seat at the table.
Okay, so in terms of what has just been said, I would mention that within the Global Foreign Exchange Committee, we have dedicated ourselves to improve disclosures. So precisely, for example, on the use on how platforms and liquidity providers are using the data that is coming from their transactions. So we even have here one of the chairs of that working group, which is precisely looking at what you said, like how do we make sure that the data that is being produced by clients is fairly used. So that's something that we will be looking at continuously. And the other aspect is about technology and innovation, and that's something that it's one of the priorities for 2026 for the Global FXC, to understand exactly how this technological change, innovation, artificial intelligence, stable coins will affect the FX market. And my message to you as buy-side participants, but also to everyone that is listening to us, is that you are more than welcome to participate in these working groups and lead the efforts for us to modify the code going forward to address precisely this type of issues. So before turning to the audience to make Q&A, let me give you maybe a last opportunity to give a word or to give a message to the buy-side participants that are listening to us today. Tyler?
Sure. I guess what I would say is that the code is not a nice to have. It's critical. And I think that market participants across the spectrum and asset owners, asset managers should continue to move in that direction because regulators care about it and clients care about it. Sell side cares about it. We should all care about it.
Tom?
Yeah, similarly, I think that it's a really good starting point, and when you work your way through it, it does provide the opportunity for you to fill in any gaps that you might find just based on that, exploration.
Ankit?
Yeah, would echo those points. I think clearly this is how FX market norms are going to be set. So it's critical that everyone agrees on that. And then beyond that, there are things in there that maybe you didn't think carefully about, that reading the code will remind you. And then finally, the fact that it's a living document and all voices should be heard as the document evolves. So the buy side is a big part of the FX market, and they should be part of this process. So I think, like I said before, like the fact that we're having these conversations and like you guys are being very open-minded about soliciting input, I think is very valuable, and I think it's an opportunity for everyone to chime in.
So the invitation is out there for you to participate and come with us and draft the code. I think it's, as you said, a living document. I think it's a very good reference for best practice. I would say it's done for the FX markets, but I can also tell you that it has already had some positive spillovers in other type of activities, in the trading of gold, in the trading of fixed income, in just the setting up of the organizations into how to engage with financial markets. I think it has been just, the contribution has been huge. So with that being said, let me open the floor for questions to any of the buy-side participants. Yes, Rui. Stefan.
Thank you. Stéphane Lavoie from the Bank of Canada. So two related questions for any one of you. So the first one is, as we try to promote awareness and adoption of the code among buy-side participants, one question or pushback we sometimes get is, it's one thing to be aware of it and adhere to it. It's something additional to publicly disclose adherence to it, because some perceive that it implies that they adhere to every single principle in it, even if some of them don't necessarily apply to their business, and or create some sort of liability if they're challenged. How would you respond to that, or how did you get over that hurdle of public disclosure in addition to adherence?
Thank you, Stefan.
I'll take a stab. My understanding is that it's clear that it is not, you have to adhere to every single one if it's not applicable. So that's an approach that the first step in our approach is understanding what's applicable and what's not. And then from there, I think, I mentioned it's really a continuous improvement process for us, and it's not like you pass-fail, like you have to, but it creates this environment where when we're looking at things like our best X procedure, some of our risk and controls, if there's things that are in it that sort of inform where we want to go, it is very helpful in ensuring that we get there. I think one way it can be helpful to buy-side participants is the types of things it's suggesting, particularly in the full front-to-back workflow and some of these post-trade things, are probably things you'd want to do anyway. So I think the trade-off of the time to sort of do that gap analysis versus getting where you need to go, if anything, maybe it helps you get budget to do what you needed to do, right? Because you can point to it and say it's part of the code, we're adhering. So I think it's a net positive, and I would definitely welcome the support of the official sector in continuing to promote the messaging around how buy-side should think about it and not feel that they're signing up to X number of things that may not be relevant.
I would just add one quick thing, which is that there's the proportionality tool, where there's an online app, essentially, where you can go in, describe how your business works, and it comes back with which of the principles are actually relevant for you. So I think, number one, the fact that it exists just speaks to the same idea that not everything will be applicable to everyone. And then secondly, it actually also helps kind of reduce the amount of legal time, et cetera, that people are going to be spending if you can only focus on the things that are actually relevant for you.
Yes.
Rui Correia from ACI Financial Markets Association. So we talked a little bit, I think Tyler, you mentioned about training, and we all talk about, okay, it's a living document, the market is evolving, and you actually just mentioned about continuous improvement. I wanted to ask you a little bit on that continuous part. How do you think it's important, the continuous learning for the staff members? Because, of course, the code gets updated every 3 years. But now, how do we get to that point into the staff members? There are market participants, individual market participants for the code. How to get them into the continuous education programs that they should have in order to implement the code? How important do you think that is?
I think continuous learning is always important in any aspect of this industry, whether it's specific to the code or otherwise. So, yeah, it's definitely not a one and done. And we mentioned, we've all ascribed great value to the living document nature of the code, and so like the training sort of is an output of that. We're always talking about it. Yeah.
Thank you, Tyler. Yes, Dagmara.
Hi, thank you. I'm part of a working group of GFXC for increasing adherence among buy-side to the code. And I understand all the reasons that you have highlighted, and that was very broad and deep. One of the pushbacks that we encounter from the buy-side is documentation and proving adherence. So I wanted to ask you about, do you document doing the reviews every 3 years? Do you have somebody in charge that can be pointed to prove that you have done the review, you have run the proportionality tool, you have mapped the internal procedures to each principle? Sometimes the pushback is, I think, Tyler, you mentioned regulators care about it, sell side care about it, clients care about it. Okay, they care about it, they come back to you and say, show me that you have done the work, rather than tell me, trust me, I've done the work.
I love other people's views on this as well. I think, without going into too great of detail on our procedures, we do look at the different recommendations and assess them versus our procedures. But I think the way the code is designed is that, yes, there's a little bit of legwork around this mapping, but most of the items, particularly as it relates to the buy side, fit into other control frameworks that already exist, things like BestX. So it's kind of this trade-off of a little bit of investment from perhaps the legal and compliance department to sort of set up that ability to read across the different principles and map them to your relevant controls. But I think that the benefits outweigh what I would consider a time investment. And you mentioned documentation. I think that's sensible to document the work that you do in any area that you're involved in.
Tom, would you like to address the
Yeah, absolutely. I think I mentioned earlier what our sort of like extra effort to get to this place was that we made this representation was marginal. And documentation's helpful, the tool's helpful that you were describing, Ankit. And more importantly, sort of setting the standard, you can either be a passenger or you can try to make things a little bit better. And we try to make things a little bit better. We're a trading firm. We're a trading firm run by traders, so making the markets better is in our best interest. And when we document this process and the next generation comes along, they have to do it. That makes the market better in a sort of longitudinal framework, rather than, oh, I think this is a good idea for myself, but what happens when I step away, or however that happens. It's, I think, very important as a market participant now to say, this is what we're going to do on a go-forward basis. And I think that it's inevitable that we're going to get to a point where everybody understands the value of that, and adding to the market and just making the market better by doing these small steps. And you sort of like figure out, oh, we already do all these things. We already have these processes documented, and then drawing the lines back is not that difficult, especially with the tools that we have available today. It's much easier to do than ever before.
Thank you so much, Tom. Yes, Adrian.
Thank you very much. Some excellent discussion, some excellent points raised. I've heard a few mentions of low bar to adherence. The code enshrines existing practices and thought processes, and that's really, really encouraging. Tyler, I think you made a very fair point. Totally agree that if a sell-side market participant suddenly appeared on the planet that wasn't here the day before and hadn't adhered, that would send a message to you, the franchise, and a liquidity consumer from that individual sell-side market participant. I'm curious what message is being sent to you, the peer group, to us, the liquidity providers, by buy-side market participants who aren't adhering today, given that the bar to adhere is relatively low if you're representative in any shape or form of the broader ecosystem. I'm just curious as to what message you think your peer group is sending by not adhering.
It's a good question. I'm happy to start. My sense is kind of to your question, I don't think it's necessarily ill will or sort of issues with the spirit of it, but I think it's perhaps a bit of education, perhaps a bit of institutional inertia, perhaps a bit of resourcing. I think that's partly what we're trying to unpick here and sort of change some of those messaging, but I think it's a fair question, right? Because it's one thing for us to look at you and say, well, here's how we think of you, but then you should rightly look back at us and kind of ask the same question of us. So maybe LPs are supposed to talk about it more with their clients.
Tom?
Yeah, I echo those thoughts. I'm not sure what folks' motivations are generally. I know what my motivations are, and I think it's a good thing. And so, again, it's sort of like maybe that should be more of a two-way street. Maybe we care that you've executed it. Maybe you should care that we've executed it. Something like that.
Yeah, very similar. I think the fact that, I guess I would just draw the distinction between adhering to the principles of the code versus signing the code. I don't want to speak for others, but I think it's quite likely that there are many buy-side entities out there who essentially adhere to the code fully, but don't see value in signing. But maybe, as you brought up and as others have brought up, if the sell side was to push for it more, maybe that would happen.
So a last word on my side. I think the FX market is clearly one of the most important financial markets in the world, and it is extremely important that it functions very well and that the integrity issues that once affected the market are completely resolved. And one way is precisely to adopt the code. So I will really encourage you in the audience and the people that are looking at us via the live stream service to take a look at the code, and I will encourage you to also participate in your local foreign exchange committees and also in the global foreign exchange committees. It is of utter importance that this market that touches our everyday lives functions very well. So with that being said, let me ask you to give a round of applause to our panelists.
So welcome back, everyone. With this panel, we're shifting focus to FX derivatives, and we will talk about the FX swaps and forward. So this is a market segment that keeps growing. At times is the swaps. This year it was more forward. And it is a market that as a combined size of the two tools is about $6 trillion in global daily turnover. So it's quite a huge market when we think about the $9 trillion of FX that Anna was mentioning in her speech this morning. And this is a market that is used for many purposes, from funding to hedging to arbitraging, and by a variety of market participants for different purposes. So we think that it's important to keep talking about the market and the structure, given the complexity and given the importance. Also, when we think that it funds or hedge a lot of global dollar activity. My name is Fabiola Ravazzolo, and I am a policy advisor in the domestic and international markets. It's a function of the Markets Group trading desk, and with my colleagues here in New York, as well as the Board of Governors, I spend a lot of our time understanding developments in global dollar activity and the offshore funding markets that fund or they're used to hedge this activity. For us, it's important because of understanding financial condition globally, but also in the US, and how we think about the backstop liquidity facilities of the Federal Reserve, such as the swap line. Today, I am honored to have here 4 distinguished practitioners from different type of industries. You can see on the top, it comes from different type of sectors, so that they can help us to better understand the structure of this market. So the way that we are going with this panel is I will pose a couple of rounds of thematic questions to panelists, and then we will open up from a few questions at the end. But before we go into the core of the discussion, I would like that if you can start, each of you can introduce yourself and tell us a little bit how you engage with the FX swap market. And Greg, maybe we start from you.
Sure. My name is Greg Emanuelidis. I work at JP Morgan. I've been a senior trader there now for almost 20 years. And I've had the pleasure of trading through a variety of different market dynamics, starting early in my career in the global financial crisis, all the way through zero interest rate and negative interest rate policy. Then, of course, not that long ago to the COVID crisis. So I've had a front row seat at a very strong institution to see the development and changes in this market. And at JP Morgan, we're uniquely set up where our desk trades all the different rate products and derivatives in the short end. So we've been a point person for our clients during all these different times of stress.
Victor?
Hi, everyone. It's a pleasure being here, Fabiola. My name is Victor Casana. I lead the FX trading team at Amazon. We sit in the intersection between financial markets and corporate treasury. We make sure that any cross-currency need for the company is covered. We cover the globe across the different regions. We're divided by regions. And yeah, I've been lucky to get into a company that has been obviously expanding and has the footprint that Amazon has right now. Early in my career, I was lucky enough to start in sales and trading, more on the sell side, and I was able to see a little bit of how banks think about derivatives in a very small market, and transition to a corporate that really helped me fill in the gaps on how the buy and sell side come together at some point. Now for the fun part is I have a disclosure. The views I'll be presenting today are my own. In no way, shape, or form reflect what Amazon is or is not doing at any given point in time. Thank you.
Thank you. Matt?
Thanks, Fabiola. My name is Matt O'Hara. I'm the CEO of 360T Inc. 360T is a global provider of electronic foreign exchange trading products, and we facilitate venues that enable the foreign exchange market to transact with each other. We provide workflow solutions, and we also provide data and analytics to enable clients to understand how they perform within the global foreign exchange market. I've been with 360T for 11 years, and I'm excited to be on this panel because I believe that the forward and swap market is going to change fairly significantly over the coming years, and it hasn't done for many years. We've seen the pace of change in other foreign exchange markets like spot really accelerate over the past 20 or so years, and I think now the FX swaps and forward market is ripe for change, driven by the need of cost control, transparency, automation, deterministic credit, and I'm really looking forward to getting into the topics as we move through the panel.
Thank you, Matt. Last but not least, Yan.
Thank you, Fabio. Good afternoon, everyone. My name is Yan Po. I lead Vanguard's foreign exchange team. So our team has 3 mandates. One is executing for all of the FX needs for all of our equity and fixed income products. And the second one is to provide insights to our investment team. And the third one is looking after technology solution in this space, because there were a lot of transformation taking place in this space, including platform standpoint and including data. So I have been at Vanguard for 21 years. Pretty much the entire 21 years is in the fixed income and FX space. Look forward to hearing more from the panelists and exchange ideas to make this market more efficient.
Thank you so much for being here. So we will definitely speak about the future, but let's start from today. So let's spend a few minutes about the factors that drives dynamics in this particular market. And Jana, we'll start with you. How do different macro policy market factors drive dynamics in this market. And when we think about this year macro environment, was something different when you think of the traditional factors that have been driving dynamics in this market in the past?
That's a very, very broad question. So before I start answering the question, I just want to paint a picture first. Basically, what is dollar's role and how dollar perform over a long history of time. So dollar's role, as you all well aware, I probably just summarized that, is dollar has this dominance role in the global saving space, payment space, and also due to the deep and robust capital market, it's also a funding market and an investment market. So this dollar dominance is there for a long period of time, and it has the network effect. We hear from the previous panelist, the market is very deep, and then it has the scale to warehouse a lot of the need from different investors, public sector, private sector. So that's the dollar dominance. And then the second one is the dollar valuation. Similar to any asset class, dollar can go up and down based on investors' expectation of the dollar performance relative to the rest of the currency. What is different in 2025 is there are a lot of new policies come out from the US, such as the trade policy, such as the foreign policy, that cause people reassess dollars' multi-decade bull performance of the dollar. And that's why you start to hear more of the dollar debasement. However, dollar debasement is connected to the dollar's performance in 2025, looking like backwards over the past 50 years. In the first 6 months of 2025, the depreciation is one of the worst over the past 50 years. And that's when the public sector, the central bankers, start to think, are we too dependent on this US dollar as a foreign reserve? Should we reduce the dependence by investing somewhere? But they need to find an alternative. From a private sector standpoint, like any of the asset managers, they have the objective to fulfill their mandate, either to achieve, minimize their volatility because they have a longer term performance measurement time frame. So what their goal is to manage the volatility, but still achieve a steady return. And that's where the hedging come into play. We hear from this morning's panel, for equity investors, they tend not to hedge because of the negative correlation of the equity performance versus dollar. But what we have seen in the first 6 months of this year, the correlation actually become positive to the downturn when equity market is lower and US dollar is also lower. So that's when people start to ask, should we hedge our positions? Even historically, they don't. So because of this kind of question being raised due to the change of the policy, and you hear more and more of the hedging, more and more of the debasement. So just try to separate how does this dollar dominance will be here to stay for a prolonged period of time, even other banks, other investors start to question it versus the dollar valuation could go up or down in any single years. It's just the magnitude for 2025 is extremely severe. So now back to, okay, what does that mean from a trading volume standpoint and from a liquidity standpoint and from a bid-offer spread standpoint? So we hear from the BIS report, so the FX forward and the FX swap and spot, they all increased in the past 3 years based on the BIS triennial report. But that's also because of the AUM from the asset managers are growing as well. So there is a reason that all of this size of the hedging is going up because larger of the proportion of the growth, it is from the asset managers. And then you also, when you talk about liquidity, during the liberation time, liquidity is a little bit thinner, but liquidity is still out there. It's just the bid-offer spread is a little bit wider. So the market is so deep. The market is functioning. And even during the CME, the temporary not being available on a month-end day, rebalance day, spread widen out. But that's not because of, it's not because a policy-driven event. It's because of the infrastructure the people are relying on to get pricing discovery. This pricing discovery mechanism is being temporarily shut down. So that is not driven by policy, spread widen out, and trade volume tend to go down a little bit.
Mm-hmm. Thank you. We will go back to pricing later. But before, I want to hear from Greg. So we hear more hedging activity in some periods this year, a lot of activity coming. But if we think about the FX swap basis this year, they barely change. They barely change when the risk sentiment suddenly change in April, or when we have seen some changes in some US money market rates, like repo rates in the fall. So what do you think about that? Are you surprised? What are factors? Is it supply story, demand story, both, something else?
Sure. So I guess first sort of need to back up a little bit and look at periods where the basis did react a lot. I mean, the two easy examples of that would be the financial crisis in 2008, and then more recently, COVID era shock, where, as Yan was saying, the dollar dominates the financial world in a lot of ways, and so many people have dollar funding needs, and during those periods of stress, market participants panicked, and you would see moves in things like LIBOR and cross-currency basis in the terms of hundreds of basis points, as everybody grabbed for dollars wherever they could in order to make sure they were funded. Now this year, like Fabiola was saying, even in a period of stress like April, where the risk-off sentiment was pretty large, we didn't see the same moves that we had seen in the past in cross-currency basis. Since COVID, the global central banks have been very focused on liquidity and have addressed a lot of the issues. That's one of the reasons why we don't see those same moves. Whether it's a standing repo facility, the FX swap lines, there's a lot of mechanisms by which to get dollars to the places that they need to be. That's one factor. Another factor is just simply the day-to-day funding has been very, very efficient and no signs of stress for the dollar. So if you're looking at very short-term, 1 week, Tom next even sort of trades, you actually see in the euro market, there's actually a slight preference for euro. So the cross-currency basis there trades positive, whereas historically you would expect a negative basis as there's slightly more demand for dollars. So that's another factor. Additionally, the market participants who in those times of stress would call and say, hey, I'm hearing there's this huge opportunity to lend dollars. People need dollars. I have dollars. How can I get them out there? People didn't really understand the plumbing of the market, and so dollars were sitting by the wayside as people were scrambling to dollars. There was an offset of those who had them to lend and those who needed them to borrow. So over the years, those sort of imbalances have been figured out, and those people who have dollars to lend are much more able and ready to lend them. So all that combines to a sort of scenario now where we're at, where even if stocks go down several percent, the cross-currency basis market will widen, but it's on the manner of a couple of basis points, not anywhere near what we're used to seeing. And even that widening is shorter and shorter lived. It might be 18 hours to 2 days rather than a week or a month's time.
Okay, a little bit more efficiency in supply-demand meeting. Okay. Let's move to Victor. So from a non-financial corporation, how do you use FX swap in global markets?
Yeah, I think from a corporate perspective, we have to divide what's the mission of a corporate and what's the mission of a trading team inside a corporate. So I would divide those on two parts. One is managing the risk. And when we talk about managing the risk, of course, we're talking about FX swaps and forwards. So it's the FX space, but that can be applied to any other asset class that the corporation faces. And then the second piece is the optimization. So FX swaps can be used for both cases. Talking to other corporates and talking to large multinationals, the use of FX swaps can be very beneficial for needs outside the country for covering or improving, optimizing the way you redeem your money from other countries. And I think a very interesting aspect that I've been looking at lately is very small markets where you might have opportunities to redeem better enhanced yields based on the difference of US dollars and dollars on how they look at dollars locally in countries that have high restrictions. I see a couple of opportunities in Latin America. I've seen a couple of opportunities in Asia. Now, that's very specific to how the corporate operates in those countries and where they are seeing, like, what is the role that obviously tax and accounting and the stakeholders play into putting that position up for grabs.
Thank you. So maybe we move to pricing. Jan, you mentioned this pricing, and we would like to understand a little bit about price discovery, the discovery mechanism, the execution. So Matt, I know this is a topic that is part of your daily job. So tell us a little bit if there is any benchmarking for FX swap pricing, what are the type of reference rate that are there and the data sources, so what is accessible to also the end users, so what is out there?
Yeah, sure, happy to. And it's a very interesting topic given the size of the forwards and swaps market, particularly the swaps market, because if you compare it to the spot market, pricing is very transparent, right? Very transparent in the swaps market. And in the swaps market, I don't think the forward curve is, kind of as transparent as maybe it could be. Is there a benchmark for the forward curve? I don't think so, no. You've got benchmarks that are made up of spot and LIBOR historically. And how do people understand where the forward curve is? And it's different for everyone on this panel. I'm a provider of data, and we provide, kind of trading tools and venues that generate data. And when you think about the swaps market, it grew, I think, just the swaps market 5% in the last BIS survey, but the previous survey from 2019, it grew 36%. So it's large, but it is just over 50% is traded electronically. And it was interesting listening to one of the panels earlier where a comment was made around, it's much more electronic, and then other people are thinking it's not electronic, and I think it's different for different market participants. And this market is going to become more electronic, which will create a more accurate representation of where the forward curve is. And there are products out there now. There are products available, commercial products. You can look at market data terminals. You can RFS your bank and find out where the curve is. And if you're a corporate, that's fine. If you're a systematic hedge fund, the bank might get upset with you stealing their curve all the time. And if you're a large bank, you can construct a curve from your inventory and your trading activity, and you construct curves from various different sources and different rates markets. If you're a smaller bank, then maybe you're sourcing that curve from a larger bank. So it's challenging. And there was reference earlier to primary markets, and if you think back to the spot market, back when there were primary markets, and then that kind of fragmented and proliferated with sold secondary venues, the reference rates originally came from the primary markets, and maybe that's not the case today, but I believe that there are going to be primary markets in the swap market, probably one or two, that will develop over the course of the next 1 to 2 years, and then they will become the reference rate, they will become the forward curve for the swaps markets. And I know we're going to talk about trading a little bit later, but they're very much correlated and kind of interact with each other, because the trading activity creates the data creates the trading activity.
Thank you. We will come back later on that, considering that from what I understand, this market will potentially continue to grow if asset under management to continue to grow and go to the US. But I want to hear from Victor and Jan how you feel about this. So where does an end user find pricing reference? So you get a price, how do you assess that price? How do you benchmark that price? Can you talk a little bit, if you can, both of you?
Yeah, so I can start. So I'll probably just create a little bit clarity. When we are talking about forward curve. So we know that a spot market is very efficient. You can do algo, you can do RFS, very electronic, like has already been, everything is done electronically. When it comes to forward market, actually WMR publish a forward curve. They also publish a forward rate. And I think that some of the, even like BestX also provide this forward curve. So that's for transaction costs validation purpose. So that's not a executable curve. So if you are a trader, try to validate, okay, I'm going to trade a 1 month forward. What should be the forward point is like? There's no best way to get that. You can look at Bloomberg, and Bloomberg have some fee. You can, WMR is post-trade, so you won't get that until you post that time. Then you will know at that point of time what was the rate. So how we try to validate that at the time of trading, because we also try to achieve fair pricing, achieve best price. You can call up multiple broker to inquire about the forward points, to get the best forward points for the size that you are trading. But you also need to be mindful of information leakage. So that is not the best way to trade. And so very recently, not to be a marketing for 360T, we just find that on 360T have this forward curve on their website that we can check to see, okay, what is the reasonable rate? So we do try and error for multiple platforms and see how good is this 360T data that we can use at the point of the time that we are trading to assess whether the pricing, the quote that we are getting is fair or not. So that's back to Matt's point is this executable forward curve doesn't really exist yet. So that's what we are hoping in the future, if there is this pricing transparency is out there to build out the forward curve for multiple currencies, starting from the liquid currencies like G10, and also make it executable. So that will be something good to have. But if we are talking about for reference purpose, for post-trade analysis, then WMR has it, and a couple other platforms has it.
I would echo completely what Jan said. I think, in my perspective, I feel pretty comfortable on how we can benchmark spot. Like there's so much information out there. We partner with a couple of data providers that gives us really good insight on all of our execution across a lot of different markets. Probably like small onshore markets is still like a challenge, but I think one of the things we were talking during lunch, it's kind of a evolutionary curve, right? Like the market starts and it's not like there's not much electronic, there's not much of an electronic side to it. And as there's more flow and there's more tools into it, you would expect this to improve over time. I've seen that in smaller markets, how they become like more e-priced and more reactive to it. But going back to like the particular question, I don't think there's like a perfect metric right now. I think maybe in the following years, as there's more flow and there's more investment on it, we will have something.
Thank you. Matt, you take note about this. We come back later about solutions, potential solution for the future. I wanted to stay with Jan, Victor, and Greg and speak about the execution methodology. Matt already said something about electronification. When we think about this market, at least from where I see, I don't trade, I just hear from you and I monitor. To me, the FX swap market has minimally changed in the last 25 years. I haven't seen so big structural changes in terms of the trading, how the trading is happening, the execution methodology. Do you agree with that? Do you see challenges, and what are opportunities there? So I ask the three, and Matt, we come back later on solution.
I'll say that while there hasn't been necessarily a huge sea change, there's definitely incremental and steady progress every year. certainly from when I began to where we are now, on the east side at JP Morgan, we've made huge strides. And using our franchise, our clients are constantly, looking for the best way that they can execute electronically, most efficiency. We're focusing a lot at JP Morgan on internalization, and every year our internalization rates get higher as we're better able to meet the needs of our clients in that manner. One problem or one, issue with the market is that there is not as much two-way liquidity at all times of day the way there is in spot. So there are periods of time where large segments of the market are all looking to lend dollars at the same time, whether that's month end. So that precludes a little bit the ability for a sort of streaming constant source of liquidity if large segments of the market are all trying to do the same thing. So I'll be interested to see how that market matures to solve that particular problem. Hopefully we'll hear more about that. But I would say that there's definitely been noticeable progress year over year, and that I'm looking forward to see more.
Good to know. Victor, Jan, do you have anything to add on this? Victor?
No, I think in my side, from my side, I do agree with what Greg was just saying in terms of there has been improvements over time. One of the challenges that we have as corporates is that we are very much subject to whatever the business needs and how we move around the business and when we have to access the market. And sometimes that means that it's better to access the market more directly with a counterpart rather than going out and showing that position, especially if we see that there's not going to be that much depth or there's not that other side is not present. So I think in general, I see things improving, but I don't, it's not in the position where I would expect it to be, especially for where we are subject to what we need to do because we have to do it. We're not taking a position or we're not thinking about this in a P&L terms, but more on how we optimize the business or how we are covering the risk that we can have open.
Thank you. Yeah, anything to add on this?
I think that from a trading strategy and methodology standpoint, there are a variety of strategy that we use. It really depending on what pair is the currency, how liquid it is, what kind of size. And then we even use a hedge pool to just transact at no risk. Basically, if its benchmark is WM benchmark, then we just match with another buy side through hedge pool. I would say that probably in the swap space, so in spot, we already have algo, but in the swap space, we don't have algo. But actually, probably from a sequence of a development standpoint, you actually need a forward curve first, executable forward curve first, and then you will start to have this swap algo. So I would think that there was a sequence of product development.
Thank you. So definitely no one solution for everyone. So, Greg, before we move to looking forward, and Matt is thinking about his answers, let's talk again, given we are on the topic of pricing, so I want to touch base on cost of trading. It doesn't matter, so you are a dealer. We know that there are some regulatory issues, may hit your balance sheet. I hear about the standardized approach to counterparty credit risk. So is still that? How do you manage? Did you learn how to manage around? Is it putting limitation how you trade and the cost of trading and pricing?
Sure. I mean, cost of trading and cost in general is always a primary concern for while we're trading, especially when we're trading such large amounts. And things like SACR definitely changed the game a little bit for us, given that it was notional based, and a lot of our trades are short-term, high notional. But we have evolved quite well, and now we are very active in collapsing trades with our other interbank counterparties, running compressions all the time. And it's now a matter of course. I don't think that it has meaningfully increased our spreads to clients, which is what we're trying to avoid at best. But it's certainly a consideration of ours. But over the years, there's been SACR, there's been GSIB, there's a number of things that we're constantly working on, trying to optimize the best way so that we can deliver the best price out the door.
Okay, so continue working for optimization. Excellent. So now let's think ahead. I wanted to keep enough time to have a conversation about looking forward and some of the issue that was mentioned. So desire to have a more standardized or executable forward curve. Electronification, yes, but with some idiosyncratic opportunities so that if you don't want to be seen. So Matt, tell us a little bit how you think electronification and standardization in this market could move forward.
I think electronification in terms of trading is definitely going to progress. I don't think there's going to be standardization. I mean, I was just thinking about who's represented here on the panel. Very large bank, very large multinational corporation, very large asset manager, large trading platform. We all come at the market in a slightly different way. What are we trying to achieve? What are the market participants trying to achieve? So trying to reduce costs, trying to increase productivity, trying to mitigate lower operational risk, trying to reduce market impact and footprint, right? And, I was just thinking to myself, like, Victor, if you're rolling a position at the end of the month using a spot algo and then you roll that forward, that spot algo is with one bank and then for the roll is with one bank, how do you achieve best execution, right? So, there's challenges there. And, Greg, I was thinking, like, volumes have gone up, kind of multiples over recent years, therefore costs have gone up as well. I would imagine that there'd be a desire to digitize and automate what you can, right? Because by doing that, you lower cost. And in order to do that, you need a liquid pool that's lit and that's got to have deterministic credit. You probably match off at opposing interest, but probably match off at mid, right? And then for that to work, it has to be a regulated venue because swaps in some parts of the world have to trade on an MTF, so it has to be on an MTF because it's a global marketplace. If it's an MTF, it's available to everyone, and then the question comes up about credit intermediation, and is this a bank-to-bank, a peer-to-peer, or an all-to-all venue, right? And really it should be an all-to-all venue, but in order it to be an all-to-all venue, then there has to be credit intermediation, and is that an agency model? Is it a prime broker model? Is it an algo? If you have a lit pool with streaming data that's very reliable and potentially becomes a reference rate, then you get algos. And I remember this time last year at this panel, one of your counterparts was talking about the desire for a swap algo. And that will enable swap algos. So I think there's different drivers that's coming from different parts of the market. So I think, kind of the big swap dealer banks are looking at how they can digitize and automate to reduce costs, like what we saw in the spot market. And I think from a buy-side perspective, there's a desire to be able to automate, to increase productivity, lower operational risk, increase efficiency, and that is happening today. There's large institutional buy-side that are transacting billions of dollars, completely automated, no touch, and they can do that using some of the tools that are available to trade today and the reference rates, the market data products that are available, but they're not widely adopted. So I think there's a lot of innovation to come, and I do believe that the swaps market is going to shift to more of an electronic, centralized model with one or two primary venues that will enable everything that I've just talked about and create more transparency into the forward curve and reference rates. I'm not going to say benchmark rates, but reference rates.
Reference rates.
Do you agree with me?
Yeah, I agree. It's basically make the pricing discovery mechanism more efficient so that it's a win-win situation.
Right.
Anything to add?
No, I was just thinking like how technology will impact corporations and their access to these instruments. Because at the end of the day, any corporation that participates, we were talking during lunchtime and I was asking Matt, like high level, the percentage of corporations that access the swap market is very small.
Swaps, not the forwards, but the swaps market.
The swaps market, yes.
Lots
very small.
Lots of forwards.
Just in corporates, yeah. But I think that it is just a cost-benefit analysis for them, for any corporate, right? Like, at the end of the day, that cost can come down, and obviously a lot of the participants that are here in this forum, just the scale that is present makes the economics of accessing the market pretty small. But for corporations, that cost is not as small. And I think maybe, and I don't want to throw AI here because everyone's talking about AI, but there are some tools that might make those things easier for corporations to access these markets. One thing we were talking with Matt and Jan during lunchtime was out-execution, right? Out-execution is something that really helps corporations be more efficient. I would like to see how that translates into FX swaps, how corporations can access those in a more economical way.
Yeah.
And when I say economical way, it's not the transaction itself, but it's everything that comes behind it, right? Like building the program, like accessing, settling the transaction, all of that, if you think about a corporation, costs a lot of money because of the size of the corporation, not like an asset manager, hedge fund, or a big bank, right?
Thank you, Victor.
It's interesting because it's like I was thinking back to a previous panel as well, and there was reference to price generation construction is electronic and not through a voice broker. But if the price generation is electronic and that's passed on to a salesperson at a bank who then provides that price to a client in yards over the phone, who then books that trade electronically, is that an electronic trade or is that a voice trade?
Yeah.
Right?
You tell me.
I think it's a voice trade, right? It's, I guess it's a little bit of both. It's a hybrid.
It's a hybrid.
It's a hybrid.
It's
right?
a hybrid. Okay, so we are the third category, hybrid.
Yeah. I think there's also a role for futures to play as well, because as you get further down the curve, cost of capital gets expensive, SAC of capital charges, credit charges, so on and so forth. And I think that there is a role going forward, and we're beginning to see this with EFPs, with what we're talking about as an OTC market. But I think, kind of the EFP into futures, I see Greg nodding there. I think there's a role to play there as well. Would you agree?
Absolutely. I mean, we're constantly trying to keep an eye on that and make sure as the liquidity in that builds up that we can access that liquidity and pass it along to our clients as best we can. So I would definitely agree that that's definitely a good avenue in the future towards cost mitigation and increased liquidity on the E front.
Yeah. And it will start with the liquid, currencies, the kind of the G7 to start off with. And, as you were saying, Victor, about the developing market currencies as a pain point, well, that's a pain point in spot as well, right? But it's being solved. So, the trend will be developed market liquid currencies, and then the others will follow.
Yeah, in fact, my next question, I don't know, Victor, if you want to share something, it was about, the smaller currency pairs. How do you see evolving? The smaller currency pairs. So how do you see evolving in this context? Are we looking?
Yeah, I think I can first start talking about how we have seen those in the spot market, and then how that has evolved on the FX swap market. But sometimes when we go, we're large, obviously multinational, and large multinationals in general, they go into G10 and we're a small player in them. But when we go to a smaller currency, smaller market, we could be one of the biggest players in the market. And I think when we talk as a team internally, globally, I'm more concerned on whenever we go into those countries than whenever we're trading G10. Whenever we're trading G10, we have a lot of tools, we have a lot of things that support us. But whenever we go to those smaller countries where the tools don't work as well, we don't have that much visibility of what's going, what are the reference pricing that we need to achieve. That is for me the most challenging part to assess and make sure that we're delivering the best value to the company. I've seen how things have improved and how we have more electronic pricing in very smaller countries, and obviously up to a certain size, and they start adopting some of those tools. I haven't seen that still translate perfectly to a futures market, and that is also a factor of the market being so small that there's not much flow to make it work yet. But as companies continue to expand, and obviously multinationals become more globalized, I would expect that to pick up and become like way more transactional. And I think all goes back to that like development curve, right? Like 20 years ago, a lot of the markets were in a very early stage, and we see how those have developed, spot, like derivatives, everything, right? I do see 10 years from now that even being more developed and more globalized. And I would love to see, I remember one of the earlier forums talking about like stable coin and blockchain, how that will come into play is super interesting. That's something everyone is talking about.
This is exactly everyone is talking about. So before we go to the audience, I actually want to hear about this. So yeah, this is a question for you. We speak a lot about modernization of payments, increase crypto trading, increase crypto and tokenized money. How do you think this is going to impact the FX swap market structure, and if yes, in which way?
So I would say this is a very emerging topic, and it's also, there are a lot of unknown out there regarding digital currency, and I really want to just comment a little bit on stable coin. I'm not an expert, but we are doing a lot of the research and try to understand this stable coin is just a cryptocurrency trading tool, and now it has already evolved into and incorporated into this regulated financial market. How would this growth in stable coin, especially US dollar stable coin, impact this FX market? We just talked about US dollar, not just in reserve currency, but as a core payment currency as well. And could the US dollar stable coin expand the US dollar's payment influence and accessibility in emerging market, especially in Latin America and in Southeast Asia, those countries that the access of dollar, offshore dollar, is just so expensive and so time consuming and so costly as well. Could this stable coin really make a difference in those markets that cannot easily access US dollar? And you all know that a stable coin is pegged to US dollar and backed by safe and liquid US assets, such as short-term US Treasury. And this is still an unknown. What if stable coin growing very, very big, and one day there is a credit event with the issuer, because you know stable coin is a private issuer? Could that cause a redemption? And what does that redemption mean to the short-term treasury market? And what does that mean to the short-term funding? And what does that mean to the swap market?
Okay.
So there were a lot of sequence of effect that could take place or need to take place. But since there were not clear regulation yet, so we don't know what is the potential implication to the swap market. But we only know that based on what we know is stable coin could be an easy accessible offshore US dollar to some of the emerging markets. And also could be a store of value for the countries that they don't have, they have a high inflation. They just want to have a safe asset to preserve their consumption power, such as Argentina. Would they be interested in a stable coin that has a much more stable value than their own currency?
Interesting. So we have to keep studying and researching and monitoring to understand the impact on the plan B. So we now take one or two questions. I'm worried we are running out of time. I don't know if there is anyone. I think there is one here from Chris.
When I think of the FX forward markets, it's one of the most efficient, low margin, low return on equity, return on capital. And I look at Amazon and Vanguard, and you're amongst the highest quality clients that we, all of us, the entire sell side, bends over backwards to service and service well. And I just can't help but think, like, is this the best use of time? is optimizing this really low margin, low return on equity, very efficient market. Is it worth, you think of like the cost of execution across all of your asset classes, everything from FX spot, equities, rates, blah, 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 and you pay $1 here, $1 here, $1 here, and you're paying a penny here, but you're trying to get that penny to be 0.1 pennies. Is it really the best use of time?
Anyone wants to take this question shortly, because we're running out of time?
So I can try, because from a fund manager standpoint, we do have the fiduciary responsibility to give the fund investors the best return. And we actually decompose the fund's return in multiple sources as well, like what is asset allocation, contribution, what is security selection, and what is execution. So as a result, that you just have to continue to challenge, are we really taking the best intent to improve the execution?
Yeah, sorry, Victor, go ahead.
Oh, no, I was just going to say, I was going to add from my side, and probably like a bit different from Jan, not on her argument, but like more on the relationship as a whole. This is just one piece of the puzzle, and I kind of agree that it's low margin, it's completely electronic base and so on, but the relationship we have with banks goes more than just like FX and just this piece, right? Like we see that as a conglomerate of a lot of different parts where probably there's more return over equity, and we would expect that to balance out. Now, that is a challenge internally in the bank. I've been on the bank side, and it's difficult to balance that out, but I think we try to make sure that as a whole, it makes sense, both for the sell side and for us. As Jan said, like our goal is to try and get the best value for the company, but we also want to make sure that there is value for the sell side supporting us on this, right? Like at the end of the day, it doesn't work. If it's not a good business for you guys at some point, and I'm not talking about G10, I'm talking even about like very small EM. Like if there's not a good return on it, then we're not going to have the support we need to operate there. And we try to value that in other like asset classes as well.
So I think we are going to end here. We are a little bit over time. And first of all, I want to say thank you. I am immensely grateful for you to come and share your very, very experienced thoughts on this. I look forward to continue to talk with you about this and also with the industry. Thank you again. And also I want to wish happy holidays to all of you. So thank you.
Thank you.
Okay. You can hear me, right? All right, good afternoon, everyone, and welcome to the panel on current developments in FX settlement risk. By way of introduction, my name is John Ritigliano, and I'm a manager in the Payments and Market Infrastructure Department. Over the last several years, a lot of my work has focused on FX settlement risk, primarily through the international work, through the CPMI, so the Committee on Payments and Market Infrastructure, as well as some of the work that the G20 undertook to enhance cross-border payments. I'm joined today by Tom Schmekel from the New York Fed, Deb Havartin from CLS, and Janet Dawson from the GFMA. So before I begin, I just want to turn it over to my panelists and let them introduce themselves.
Thanks, John. I'm Tom Schmekel at the New York Fed. I also work in our Payment and Market Infrastructure Analysis team, primarily focused on payment system risk, both at financial market infrastructures and at large payment clearing and settlement banks.
Good afternoon, I'm Deb Havartin. I'm the Chief Risk Officer at CLS. For those of you who may not be familiar with CLS, we are a designated financial market utility. We are the largest multi-currency settlement infrastructure in FX markets, settling for 18 currencies, all the major currencies. And I'll give you some stats later on where we are with our infrastructure and the developments in the market. I've been there for about 6.5 years. Prior to that, I was an investment banker at Deutsche and Citigroup, and started my career actually here as a bank examiner at the Federal Reserve.
Hi, I'm Janet Dawson from the Global FX Division here in the Americas. The GFXD is a trade association representing 25 member banks. We look at both tactical and strategic topics for our members. And prior to joining the GFXD 3.5 years ago, I spent the term of my natural life in foreign exchange, starting over 30 years ago in retail, corporate and institutional foreign exchange across Sydney, New York and London.
Great. So as I was on my way here, thinking about how to open a panel on such a riveting topic, such as FX settlement risk, I was quite frankly uncertain if the audience would care, given the other panel topics on hedging strategies, liquidity, and dare I even use the buzzword innovation that is coming after us. But I was pleasantly surprised that I did hear the phrase settlement risk mentioned 4 times so far, at each of the panels. So in fact, one panelist even said, and I'm paraphrasing, that the settlement piece is critical to the functioning of the FX market, which to me means that I don't have to convince some of you how important this panel discussion is. Of course, the collapse of Herstatt Bank is far in the past. It was 51 years ago, so dated June 26, 1974, and there were a lot of lessons learned at the time of the collapse related to the settlement process for foreign exchange transactions. A lot of progress has been made over the last 51 years, and I won't go into all those efforts because we'll be here for at least 45 minutes, but most of this progress came through public and private sector dialogue and coordinated action, which underscores the importance of dialogues like this, where we have the public and private sector here to discuss issues. So while a lot of progress has been made, I think that we have all seen the BIS triennial data that shows that FX settlement risk is still unresolved and that the amount of global risk still exists and is quite large. Therefore, it seems like more could be done, so I will turn it over to my panelists for their views and their perspectives. So starting with Tom, could you maybe just highlight some of the things that the public sector is focused on?
Sure. So I guess before I'll start, I'll do the generic disclaimer that I'm sure you've heard countless times already today, that these are personal views and not views from the New York Fed or Federal Reserve System. But I think from the public sector perspective, from a policy and oversight view, really see 3 key areas of focus. So the first is kind of the long-standing North Star to eliminate and reduce FX settlement risk. I think the second one is very closely tied to that, around gathering better data to monitor where settlement risk, where we are, what are the trends, understand the drivers of that. And then the third, which is maybe something that we don't talk about as much in the context of FX settlement risk, is really thinking about the resilience of the settlement ecosystem. And I think there we mean kind of the market infrastructures, the banks, third-party service providers, and how each of those entities is kind of individually resilient and how that kind of collectively adds up to resilience for the ecosystem as a whole. And like John mentioned, I think all of these are kind of underpinned by public and private sector dialogue and cooperation and really kind of our collective efforts. So in the first focus area, obviously this is the long-standing goal to encourage market participants to utilize settlement methods that eliminate, reduce, or better control settlement risk exposures. So, the 2013 Basel Committee guidance, more recent CPMI Basel Committee kind of statements in 2020, and of course the most recent updates to the FX Global Code are kind of all underscoring this. And I think it obviously starts with the use of payment versus payment where it's practical and available. And I think there we really could think about the benefits of PVP in kind of 2 ways. And one is the kind of the more micro-prudential, firm-specific, just given the sheer size of the FX market, the underlying notionals, the potential credit exposures there are massive, and eliminating that risk, the principal risk, is extremely important. but also from a more macro or system perspective, we've seen kind of where PVP supports a more resilient market overall, especially in times of stress or crisis, creates trust in the market to kind of allow payments to continue settling, provides netting benefits as well to that goal, and really avoiding situations of payments gridlock where, healthy banks may face liquidity issues, or we might start to see things spill over into domestic payment systems, or into other markets. And then thinking kind of further down that waterfall, and I think really captured well by the updates to the FX Global Code, or thinking about where PVP isn't available or isn't practical, what are the netting arrangements, central clearing, and things that could be used, and really encouraging the use of those. So that's kind of the first area of focus, and I think that's kind of the very familiar one. The second part of it is really then kind of, I think, gathering, analyzing, and socializing data on the market. And I think this has been a journey that we've been on with the BIS triennial surveys and the most recent one kind of to come to really get better quality of data to understand where FX settlement risk remains as a kind of an overall turnover, what are the trends and drivers of that. And then I think part of this is also thinking about how developments in other asset classes and other markets are also affecting FX settlement risk. So we've seen T+1 migrations and securities markets, and how does that impact FX settlement? So kind of keeping that kind of monitoring both, on kind of the core, but then also looking at other markets and how they're impacting it. And then finally, just a little bit more on that third area of focus. And I think, here it's really, I think, increased recognition that, the FX market is critical. The transactions are critical to the real economy, to the financial system. It's growing immensely. I think record settlement values just today. And that those payments continuing to settle, it really depends on kind of careful orchestration across many, many players in a complex connected ecosystem that's becoming more connected. So I think from an oversight perspective, really thinking about, the resilience of the core infrastructures like CLS or other PVP providers, RTGS systems, the resilience of the settlement banks, their correspondents in that chain, and then third-party service providers that are kind of supporting, outside of the kind of the core, but supporting many of the services. Looking at what are their individual resilience, operationally for disruptions, financially, but then also thinking about that kind of from an end-to-end perspective, and how do the individual capabilities fit together. And I think that's an area, again, on the theme of public and private sector dialogue, where there's a lot that can be done kind of jointly to really kind of understand and pressure test that more. So hopefully that maybe sets up a little bit of our conversation and some themes to kind of pick up on, but yeah.
Yeah, thanks, Tom. So in terms of theme one, it's the FX settlement risk waterfall, 2 is the data, and 3 is the ecosystem resilience. Maybe could we hear from the private sector on the FX settlement risk waterfall and the data? And I'll start with Deb.
Thank you, John. And today is a remarkable day for CLS. So I know there's been a lot of discussion on the triennial survey and a lot of the results showing the FX market turnover on a daily, I think, average of $9.5 trillion, 27% up from 2022. We're seeing remarkable increases as well on our side. We're about 36% up on average daily traded volume since 2022. Today, actually, the year has been very volatile, and I just want to say that the market, our members, have been extremely resilient. We settle every day with little to no issues, and it's been quite remarkable how resilient the industry has been. But with today's record value, our record value today was $22.9 trillion, which is quite tremendous for CLS. And that just follows a day in September where we had about 20.1 trillion. So you could just see just the rise of the volume and the volatility that we've seen over the course of the year. One thing to note is that the funding required to settle that in a multilateral netting PVP settlement fashion like we have at CLS was only 91 billion. So that is about 0.4%. So very, very de minimis risk. And as you said, a significant reduction in principal risk, which is really what we want to do. We want to deliver significant liquidity and funding benefits back into the FX ecosystem, which clearly today was a record day for us. So I'm glad I'm here to mention that. I would also just say that, further reducing what's left in the industry, and I think John will speak a little bit about what's left, and I think it's about 10 or 15% where we don't have funding or settlement, risk mitigation, and that's what we need to tackle, is specifically in emerging market currencies. And this is where, so for us, it's 18 key currencies, 76 settlement members, about 38,000 third parties. We're tapping everything we can to reduce FX settlement risk in the industry, but the core now for us, and I think the market, both public and private sector, and we work through the PI task force, the CPMI, and many others to reduce that and have that conversation, is what can we do more in emerging market currencies. And collectively, I think also in the BIS triennial, the indications are obviously that turnover is rising significantly, in particular in the onshore and offshore renminbi against USD, one of the most actively traded currency pairs. So those are some of the areas that we, as a public and private sector, need to continue to advance and think about how our ways of reducing that risk exposure. We do also have a product called CLS Net, which provides bilateral netting opportunities for those currencies. We operate 120 currencies, but again, the more we can move into the PVP market is really critical for us to continue to mitigate the risk exposure that's left.
Great. Janet, any follow-up comments?
Yeah, sure. As I mentioned before, we got 25 bank members, and settlement risk is a key priority for all of them and for us always. So it's a very key topic. One thing I'd add just about this settlement risk waterfall is, that we kind of looked at sort of going back sort of 2019 and 2022 BIS data and looking at what the outstanding amount of settlement risk is. And, as you may be aware, the, revision and as referenced here that, it's now looking like 10 to 15% of the gross number of FX is actually what your settlement risk. But if you're looking at 9+ trillion in volume, that's still, that 10 to 15% is still a large number. So what I'm going to talk today about is about the waterfall, but also about the accelerated settlement cycle, just two areas where this topic has really been relevant for our members. So first up on the waterfall, what we'd say is we actually did the ground up work. We went through the members and said, well, okay, what's making up this 10%? And, can we get that down even further? So half of that 10% basically is made up of what was just referenced around, currencies that sort of sit outside PVP mechanisms and CLS. The other half, interestingly, is around same day payments that miss netting benefits and miss payoffs. So that's still a large amount, and so we'd use this forum to encourage market participants to reassess their process and look for opportunities where they could potentially change their process to help lower the settlement risk, particularly in the thematic of moving towards an accelerating settlement cycle. We've done extensive pieces of work over the last 2 years in particular. First up, T1 here in the US, Interestingly, working with the industry to help everybody get their heads around and working through a faster settlement process, and particularly the impact for foreign exchange, for American-based and offshore-based counterparties. And through those discussions, one of the key themes that came up, particularly amongst the asset management community, was making sure to maintain access to CLS. Sort of fast forward, we got through UST1. The GFXD is now working on with the UK and the EU with a similar sort of thematics, different time zone, admittedly. But we've also looked at T0, and there was discussions last year with the US move to T1 around spot moving to T+1. The challenges there, I would say, is that what became quite obvious was that if it increased settlement risk, it was actually potentially increasing systemic risk. And given the current rails of the system, moving a spot to T+1 convention, some people would say, well, so what? We can do that now, and we can do T0 now. But when you're talking about a convention where you're talking about the whole market, where you've got a number of corporates and real economy reliance upon safe settlement of the currency, it's really important that you get it right. And so we believe that the T+2 spot settlement cycle is adequate in the current rails. We're going to have a panel right after this. It's going to be able to talk to you about ways that this is being modified and systems being adjusted to actually be able to deliver that. But certainly from a settlement standpoint, from the current rails and given the size and velocity of the market. The other thing that we're looking at too is, going back to what I was saying about processes, is, what is it that you can do differently to help improve settlement risk? And so we do a lot of work around trade process optimization and where is there opportunities to improve. And we're looking at the trade allocation process, for example, where the use of pre-trade allocation is optimal, but there's a lot of post-trade allocation notification going on, which increases settlement risk, it increases costs. And so the efficiencies of that process are being challenged. But it's so, philosophically, it's a change in behaviours, which we all agree is not an easy thing to do. But I think it's important to recognise that even in our current processes now, before we all move to a digital world and sit on the beach somewhere because it's all going to be done agentically, I think it's important that we review the current processes and maximise the opportunities we can to continue to lower settlement risk.
Great. Janet, maybe just to follow up. So on the T+1 transition for the UK, EU, and Switzerland and its impact on FX settlement risk, have your members seen any impact or foresee any impact, rather?
I'll start out by answering it with a US lens, because that's just the way I'm built. The first part is, I think part of the reasons that were cited that the US was so successful was because people were prepared, that there was a change in behaviours around increased use of technology to be able to meet the expedited settlement timelines. And I think, having gone first, we've kind of been able to then share the benefit of those learnings to the UK and EU team. So the initial work, my colleague Andrew Harvey in London's been working with with CLS and with the UK and with the EU in this transition, noting that, given the benefits and the challenges that we noticed and the difference in the time zone, obviously, as I mentioned earlier, the access to CLS was critical for the US. They don't have that same challenge, but where they do have a challenge is what's coming from Asia. So, I think early preparation, the working groups are well in advanced. I know the GFXC has just published a paper. We're involved in that working group as well around the settlement risk aspects of the move for UK and EU T1. So at the moment, not yet, but they've still got 2 years to go.
Deb, any work?
Yeah, no, I echo what Janet has said. I think we're very well prepared. We saw very little de minimis outcomes or any risk from the Canada-US. I think for the European markets and in the UK, the time zones are clearly much better for CLS. Operationally, I think it will be a lot easier. It's a very small proportionate share of impact, 0.1, I think, for the European markets and 0.4% of our overall value with respect to UK. But I think it's much more complex in Europe when you think about the fragmentation across the currencies, the custodians, the depositories. So there's a lot more engagement that needs to encompass the shift and the move. So a bit more operationally complex, and as you said, in the Asia markets. But I think the industry is very well prepared to progress, and clearly this continues to mitigate, obviously, settlement risk and pre-funding and ultimately T0, which is the ultimate solution for settlement risk.
Great. I want to move on to the ecosystem resilience topic. So a bunch of other panels talked about the ecosystem in terms of their environment, so the hedging and the liquidity ecosystem. But Tom had mentioned ecosystem resilience from a settlement perspective and the infrastructure that supports foreign exchange settlement. So Deb, could you maybe comment on that and kind of the work that, or how CLS thinks about ecosystem resilience and some of the work there?
Yes, absolutely. Front and center, and I want to just thank all of our members for supporting us. We have fast forwarded our enterprise resilience program over this last several years. We have created an alternative processing site which sits outside our main site, which allows us to dynamically cold start and clean room our environment in the event that there is anything that is mid-settlement cycle where we are required to move and to remain our resiliency. We do something called the market-wide test every year with all of our settlement members as well as our vendor community, which is very key. I think you mentioned earlier the third-party, fourth supply chain risk, really critical in our industry and many others to ensure that it is resilient and we can all operate end-to-end. So those tests we do annually. We just completed ours with all of our member community, very successful, where there are replayed transactions back to us as if we were having a cyber related incident or a data compromise. Those are very critical. As an industry, we need to do more of that engagement together in order to ensure end-to-end we are fully resilient. So whether it be us working CLS with SWIFT, our vendors such as Finastra or others, as well as our settlement member community, the end-to-end is very critical. And those tests and those scenarios, extreme but plausible, and unfortunately more of them are more plausible than ever before, are really important to think through. So we've been doing quite a bit of that over the last several years, and as I said, just completing our last exercise very successfully.
Great. Janet, any thoughts on ecosystem resilience?
Yeah, absolutely. I think, well, first up, I think we had a test in T1. Admittedly, it was well flagged, but, we had a resiliency test live last year and people passed with flying colours. You actually asked earlier on about, about that topic and, sort of talking to the EU and UK working group, they asked, are there any lessons learned? Would you have done anything differently? And there was silence, right? I mean, it's not like, slap on the back stuff. There was a lot of work done by the industry, and I just cannot stress how important it was that the industry was so engaged in making that change. So, outside of the T1 piece, on the resiliency side, we actually did a piece of work last year just looking at, what would happen if a settlement system was to fall down. And we looked at it not only from a couple of hours or a couple of days, we looked at it out to 6 weeks. And there are a number of findings that we found, for members, but the important thing was that, I think, one of the key learnings is that if it is an extended outage, that, it's not a matter of just flicking it back on and off you go and everything's good again. It's about being able to retrust that connection again, and the processes that members had to go through to enable that reconnection, I think, was a real learning. And the other side was around, a globally trusted single source of truth. If you like, there's a police incident in New York who you call the NYPD. There's an FX industry, event, who are you going to call? So, I think there's some work that's been done on, what would be a globally trusted single source of truth for the market to call if there was an issue or an outage in foreign exchange. Thankfully we did this work in 2024, and the second part that came out of that was, what would happen with CLS, and thankfully you've just heard about the great resiliency work and planning that CLS have done. And the third piece was around, confirmation messaging, was engaging with SWIFT and understanding exactly what their resiliency program was. So, it's front and center, and, we've heard about earlier today about, issues with the CME the other week, so it's going to be an ongoing theme, I think, just emerging at different points and hopefully not that often.
Great. Tom, I'm assuming that you like to hear when the private sector is coordinating market-wide tests, but anything to maybe add or?
No, I think maybe just yes. To underscore, I think, kind of where we started with this, I think this is increasingly important. I think the number of players, the time zones, the short time windows, that the testing, and kind of bringing more of all of the entities together in kind of increasingly sophisticated and stressful scenarios pays a lot of dividends, and that it's something that needs to be addressed at an institution-specific level, but then also really making sure that the capabilities and planning across individual institutions are harmonized and are adding up together to kind of support the collective resilience. So,
great. So maybe just in the last 10 minutes before we open it to audience Q&A, I just want to go back to the private and public sector dialogue and the importance there, and maybe just open it to my panelists to see if there's any areas or topics where you think public-private sector dialogue at this point could be very beneficial to the FX settlement risk theme or topic. So maybe starting with Janet.
Yeah, sure. I think, as I mentioned before, I think, this environment we're operating in, an accelerated settlement, I think just because you can settle something instantly doesn't mean you should or you could. I mean, there's a lot of implications on that, and again, we'll hear about it later today, but I think, understanding the implications of liquidity and funding, the faster and faster we need to settle, I think is a key area of focus for the industry. I think, accelerated settlement is probably the main one.
Deb?
Yeah, just adding to that, we're very active in the G20 cross-border payment initiatives, public and private sector conversation, alongside the roadmap, and of course embracing the global FX code, which is really key, shortening settlement timelines, of course. But back to, I think the biggest challenge facing us is trying to solve solution PVP for emerging market currencies, which is really, I think, the most pressing topic for us, and we're on that journey and moving towards hopefully solutioning some of that. And I think the public-private sector engagement is clearly very beneficial in those conversations. So I thank you for that. I also think that just on shortening the settlement timelines and hours of the RTGS systems, we have to think about the Nostro providers and aligning those timelines to make it clearly ultimately efficient. So just adding on to what Janet said, I think those are really the key topics for us to focus on as an industry and try to solution together.
Tom, anything to add?
Yeah, maybe thinking about it two ways. So I think there's one from the public sector side, dialogue and understanding what the private sector is working on is, I think, really important to understand what are the new services, new opportunities, innovation that could help further reduce FX settlement risk, potential new models that could bring coverage, like Deb was saying, to more currencies, emerging markets, more participants, or provide more flexibility in settlement. So that dialogue, I think, from a public sector perspective is extremely important to understand that. And then I think the flip side of that is, a lot of these solutions and opportunities are really brought to fruition by the private market, need to be adopted by the private market. But from a public sector perspective, it's understanding what are certain things that could help support the private sector in that. So I think an example of something that's very live right now is expansion of RTGS operating hours and what are the opportunities there from a settlement perspective. So where there are barriers that could be removed or that could help further support opportunities to reduce settlement risk, that really comes through in that dialogue. So
Great. So I think we have time for audience Q&A. So maybe we can just open it up to you all to see what questions you have for our panelists.
Someone in the back.
Hello, Richard Lovich from NYU Stern. About 10 years ago, CLS surveyed its members to ask how they settled their FX transactions. I think it was in 2013. And what was puzzling was that even after adjusting for trades made by members in non-CLS currencies and counterparties who were not third-party members, the fraction of CLS-eligible trades that were settled within CLS was still in the neighborhood of 50%. And I know that's improved, and I think the BIS is asking in their survey, how do you settle your trades, which is kind of an obvious question to ask, but it's still less than 100% of CLS-eligible trades executed by CLS members that are settled by CLS. So I wonder, how come you join a club that you don't use their services? And are there thoughts in mind to encourage more use of the PVP settlement members, settlement within CLS by the CLS members, of which there are 38,000 eligibles plus the members themselves? What keeps it from being less than 100% participation, do you think?
Yes.
This is why I wish we had a bank on the panel so that they can answer from their perspective. But
So I am pleased to say we continue to progress our membership. So this year we have 3 new settlement members that we have onboarded in addition to a new jurisdiction, Hungary. We do have a very strict eligibility criteria with finality. So the 18 major currencies that are in the main settlement service, there are very strict requirements and a very stringent CLS risk design to mitigate risk across the membership community. So that this has been a very significant year. We've also introduced CFX 2.0, our Cleared FX platform, which now integrates the clearing activities that come through LCH now into our mainstream, streamlined into our settlement session. So there is a continuous membership dialogue and opportunity there. Our 38,000 third-party participants, it does continue to grow. That is highly dependent on the settlement members' activity with their third parties in influencing the third-party activity to come through to CLS. But I think, as we said, we've reduced the exposure in general for the market overall to about 10 to 15%. So it is quite significant from when 2 decades or 3 decades ago we started this journey. So it is progressing. It is, I think, just it's a united effort on all of us to move that dial. But again, I think on the EM currency front, where we're seeing clearly in renminbi, whether it be onshore or offshore, renminbi, those percentage points are up 8 to 9% of that market share. It is quite significant. It's something that is outside of CLS right now, and that's where we're looking to design very similar PVP solutions that we can provide that opportunity to our members in order to exercise PVP in those non-CLS currencies today. So I am hopeful that you will continue to see progress.
What I would add too is adding to what Deb was saying is that obviously PVP is the preferred solution. That waterfall that we referenced earlier, you know, it actually represents 85 to 90% of the volume each day, you know, of which if it's outside of PVP, there's other, you know, netting and settlement risk, you know, mitigating tools that people can use to help lower settlement risk. So I think, you know, the market and the industry is very active in making sure that people are aware that there are these other tools like netting, you know, on us settlement, single currency. So there's, you know, other forms of settlement risk mitigation that sort of make that 85 to 90%, recognising that PVP sits at the top of that stack and it is, you know, obviously the preferred solution. But, you know, I think, you know, there is a lot of work being done on the others to help lower settlement risk overall.
Hi, this is Brooke Bauer from JP Morgan. At lunch, we were having an interesting dialogue around FX tokenization and the use of blockchain systems and even stable coins around settlement. And I'm curious if you guys have any insights on maybe the challenges that we should be thinking about in that space and just where you see the future of this going.
I think that's a great soiree into the next panel, but just very briefly, it's absolutely on everyone's agenda. I think it's probably too early to say exactly what it's going to be. Just, you know, what a stablecoin means for FX. What does it mean for settlement? When do you settle? What's a spot stablecoin settlement? You know, there's just so many, you know, new and, you know, uncharted territory that's come up there yet. I think it's on everyone's agenda, and I think as the tokenisation market grows, I think it's going to become even more urgent to see what the response is. But I would say at this point, I'll defer to the guys in the next panel. They're the experts on this one, and, you know, really looking forward to hearing what they say.
I had the same question, sorry.
We're hoping the next panel with potential questions. Are there any other questions? Someone right
Hi, Brett Berger, Federal Reserve Board. The Fed announced recently that it would be extending FedWire operating hours to 22/6. And I was wondering, you were talking about the shorter settlement windows moving to T+1 and then maybe even T+0 at some point. How does going to 22/6 and eventually 22/7 if FedWire does, how does opening the global settlement window help, and what are the areas that the other countries that would be most helpful in terms of expanding the global window?
Was that directed to me?
Yes.
Or all of us? Okay.
Though everyone is free.
Yeah, no, thank you for the question. So what we see just generally in CLS is the market generally operates, most of our members one-shot fund in the earliest grid, the earliest part, so 7 a.m., 7 to 8, 8 to 9 CET. So opening the window, I mean, it really is, I think, an opportunity for us to obviously have, you know, improved liquidity and funding benefits. I think what we see is the risk does exacerbate or potentially can exacerbate as our settlement session is extended. What we are thinking about also is, could we shorten that grid? Because naturally, funding liquidity is in very early on. So I don't have an exact answer on the benefits of that. But I do, you know, what we are trying to do is think about all opportunities to reduce the risk exposure. Some of that is, could we shorten the settlement cycle itself? And we're seeing, you know, for the most part, anything against the, you know, the USD is generally, it's 80 or 90% is kind of one-shot funded in those first two grids. So there is de minimis risk that's left over. So, it's really, I'm not exactly sure on benefits or does that give us any added liquidity or funding benefits to the market, but overall, we're always trying to obviously reduce the exposure.
Yeah, I mean, I think maybe one thing for the non-PVP values and volumes, so those that settle outside of CLS that rely on the correspondent banking network and the RTGS systems, I think more overlap in the global settlement window. So as RTGS systems expand, the duration of FX settlement risk that exists through the non-PVP channels could be further reduced. So for certain dollar Asia currency trades that are not settled through CLS, you could have outstanding FX settlement risk over the entire weekend. So, if Fedwire opens on a Sunday, that could potentially be reduced, assuming that the correspondent banks also expand their operating hours. So that's maybe a different angle outside of CLS. I don't know, Janet.
Yeah, the only other thing I'd add is like changing market structure. That's why we're here today. I mean, you're looking at what's going on in equities, and you're starting to see that, with exchanges looking at extending their number of trading hours globally. And then, you've got what we just heard, a sensational outcome for a massive amount of trillions and trillions of dollars netting down to, 91 billion, right? So I think the point I'm trying to make is one's about not losing access to the benefits of netting. And the second one is just keeping an eye open on what's going on in the other asset classes and how that impacts, what's going on and the needs for foreign exchange. Yeah.
Okay, I think we're at time. So I want to thank our panelists, Tom, Deb, and Janet, for our discussion today, and everyone maybe give them a round of applause.
Thank you.
Good afternoon, everyone. I'm Per von Zelowitz, the director of the New York Innovation Center. The New York Innovation Center is a function in the markets group here at the New York Fed that conducts technical research and experimentation, where we test emerging technologies like tokenization, artificial intelligence, and others to understand if they can deliver value propositions to solve specific central bank-related problems and opportunities. We do quite a lot of work within cross-border and FX. So if you visit the New York Fed website and read our research, you'll see specifically some of the use cases and research that we've conducted. I encourage you to do that, and I also welcome feedback. So if you have ideas, criticism, comments about our research, please feel free to reach out to me and share that with me. So I welcome you to the last panel of the day. Our discussion will be on innovation and the future of the FX market. And so far today, we've heard a range of topics related to the FX market, from understanding the evolution of spot markets to the settlement landscape. We've also heard the triennial survey referenced throughout the day. That's a great indication both of the growth and the size of the FX market, but also the importance of the FX market. On this panel, we'll look a bit more to the future. So this will be a forward-looking discussion on innovation and the future of the FX market. And it's clear that the FX market is changing, and it will continue to change. So there are developments within technology, again, artificial intelligence, tokenization, new instruments coming to market within the digital asset space that are all drivers of some of this change that is taking place. And we'll have a discussion around many of those topics in just a moment. We'll discuss what might change in the future in addition to those areas, but also where is innovation happening today and why? What types of problems is the innovation trying to solve? What are the opportunities that the innovation is uncovering in the FX market? And we have the privilege to be joined by an esteemed panel today. So Will Artingstall from Citi, Sunil Sharma from Circle, Harsh Sinha from Wise, and Tom Shack from Swift. So I'll start by inviting our panelists to introduce themselves and also offer a few opening remarks before we go into specific questions. So Will, can I start with you?
Sure, happy to open it up. So hi, Will Artingstall. Been at Citi a long time, a lot longer than I'd like to admit. Started when I was a teenager. but have been, and also have done just about every job the bank has to offer, all within our transaction banking business, based out of New York, part of our global payments product organization. For the last 2 years, I've been lucky enough to run our e-commerce services and digital asset payments business. Pretty exciting and burgeoning space for us. I think from at least Citi's perspective, we've been quite vocal in the last year about some of the activity and the work that we've done. We've got some great platforms out there like Citi's Token Services, which is a tokenized deposit platform, allowing and enabling movement within our own network today. We've been sort of increasingly talking about interoperability. We've had a couple of external announcements, like the partnership we've just signed up with Coinbase, and some of the additional interoperability we've done with Citi Token Services and some of our historical and opened up 24/7 payments platforms like our dollar clearing infrastructure. So pretty exciting space. I think we're quite excited about where this potentially could go, and have been at the forefront of that over the last year.
Thank you. Sunil?
Hey everyone, I'm Sunil. Honored to be here. I currently work at Circle as the Vice President of Product for Circle Payments Network. It's our global money movement platform. We recently launched it almost like 7 months back. Before Circle Payments Network, I used to run compliance, risk, and financial integrity platforms and infrastructure, which is the foundation behind our stablecoins and global compliance. Over the last 2 decades, I've spent a bunch of time across big tech, across founding companies, and the core theme of my experience has been around speed, scale, and connectivity. And that has now become the foundation for Circle Payments Network as well. Now, just to offer a point of view on the market, I'll maybe say 3 things. One, if we maybe look back 30 years when the beginning of commercial internet was happening, it felt very transformative back then. But in hindsight, it was just the beginning. And no one had a clue about what business models and innovation was coming our way. And I believe that's where we are in finance today. We are setting the foundations for a new open programmable global financial system. And talking about maybe quickly FX and settlement, this risk has come up multiple times. The biggest risk is settlement. And blockchains and stablecoins were built to solve for that risk. And now talking about maybe the future and friction and velocity, we have seen time and time again with communication, with content, with media, over the internet, when email came about, it did not kill postal mail. When messages came about, it did not kill email. When WhatsApp came about, it did not kill messages. In fact, what has happened is the capacity has gone up and the volume has gone up, million-x. And that's what we are seeing with USDC as well today. There is like 78-something billion of USDC in circulation, but we have done $50+ trillion of transactions in the last few years. What that means is when the friction goes away, the velocity goes up, million-x. And that's what we are expecting will happen with money as well. There'll be millions of transactions every day, FX transactions, micro FX transactions every day. So I think that's the opportunity we all have, not to replace or disrupt the system that we have. The system that we have today is regulated, it's compliant, it's scaled, it has the distribution. I think we have the opportunity to give it superpowers to make it next level.
Very good. Hi, I'm Tom Schack. I'm the Chief Innovation Officer for Swift. And I have to say, when I got the invitation from Per to join this session, I instantly said yes. I love FX people. I love the FX market. And I was really happy to be here today. I also wanted to start with, I don't have a standard disclaimer to share with you. I can say whatever I want. But I can also tell you that I don't have a crystal ball. And usually in these kind of sessions, what I find works really well is that when you leave, you have better questions than you came in with, right? There's a lot of things that are happening. There's a lot of moving parts in every aspect of the FX market structure. Many of those have been covered today. But I don't have to worry about a standard disclaimer. I have the trust of our executive team, and we have a very deliberate strategy, a very consistent message. I've been at Swift for 6 years now. Prior to that, I actually ran tech and ops at CLS. And so Deb just talked about some of the kind of updates that are happening there, but we introduced the CCP service, we introduced CLSnet, we introduced CLS Now, which is interesting because it's real-time FX on a bilateral basis settled in central bank money. And that's something we launched in 2017, 2018, right? So what we're going to talk about, I think, today is like what's different, kind of why now, And I think there's good reasons for that, but there's certainly things that still need to be cleared up and worked out for us to do this kind of globally and at scale. Before CLS, I actually ran tech and ops at London Clearing House. So I'm kind of 15 years of market infrastructure. And then before that, I spent all my time in investment banks in technology, primarily in FX futures and options and exchange traded products. And even had a conversation at the beginning of the day with some Barclays people. I started FX technology in Barclays in 2003 with Ivan Ratosa and Bob Diamond and that crowd building Barks. That time we literally had 7 people in FX IT at Barclays Capital. I mean, so obviously this industry's changed a lot. The scale has grown. We see record days on CLS even tomorrow. And I'm just really happy to be part of the conversation today.
Hey folks, my name is Harsh Sinha. I am the Chief Technology Officer at Wise and also the President of the US business. So first of all, thanks for having all of us. Actually, this is a pretty amazing panel given the different angles we'll come from. Just a quick question, how many people know about Wise? Okay, not bad, that's good. So yeah, I wish I could say most of the gray hair on my head was because of my 7-year-old and 3-year-old, but actually most of the gray hair on my head is because of building money movement around the world. I've been in this space for about 22 years, previously for about 10 years early at eBay and PayPal, and then for the last 11 years trying to build this network that helps us move money around the world with Wise. Just to give you context, we move about $200 billion cross-currency every year. If you look at our same currency transactions, including dollar clearing, we'll cross $500 billion a year. And basically what we enable consumers and businesses to do is be able to move money, whether they were doing dollar clearing around the world or whether they're doing cross-currency transactions from point A to point B, where point A is a bank account and point B is also a bank account, so it's not closed loop. That is obviously much easier to do. But from source bank account to destination bank account, usually within 20 seconds. And this 20-second SLA was actually created by Wise in 2018, literally in a Slack channel to say how fast can we move money around the world. And that became one of the hallmarks in the industry that we've been able to measure and push towards. And now we settled 74% of our transactions of this 200 billion in 20 seconds, source bank account to destination bank account, which means somebody who wants to clear GBP to Australian dollars into Royal Bank of Australia, or like say Macquarie Bank in Australia from Barclays can do it source to destination in 20 seconds, with all the compliance checks and everything done. So how did we do this? We did this by actually looking at the 2 legs of the transaction, an FX transaction, and connecting both legs directly to local payment systems. And luckily for us, when we started this journey, domestic payment systems were also evolving. So a lot of the countries took the instant payment system route. And we became the first payments company. We're not a bank, we're a payments company, payments licensed, to connect directly to 8 payment systems around the world. And that access has enabled us to then move this much money so quickly and for very cheap around the world. Generally, most providers will charge about 3 to 4% on fees and markups. I'm talking about retail. Our blended rate is 0.52%, and we're a profitable company. So I think there's still a long journey to go. There's a lot of new technologies that are coming out, so it'll be a good discussion, but just wanted to give you a brief on what we've been able to build. And actually, the existing rails work pretty well. I agree with what Sunil said, we can supercharge some of the existing money movement in some areas by adding new technologies.
Thank you for sharing your background and your perspectives with us. And it's clear that we have a diverse panel. So you're all coming at this market from slightly different perspectives, different business models, playing different roles in the ecosystem. So I'm looking forward to the discussion that we'll have. And with that, I'd like to target the first question to Sunil and Will. And could you share with us your point of view on how instruments like stablecoins and tokenized deposits and capabilities like tokenized settlement are changing the FX market microstructure? And related to that, how are these new competitive forces shaping the market?
Yeah, I can go first. So as we look back, we heard this multiple times today, one of the biggest risks in settlement, in FX is settlement, right? And why is that a risk? It is a risk because it's done through intermediaries. It's slow and fragmented. And that is the primary problem blockchains and stablecoins and tokenized deposits were built to solve for. We recently published a white paper on stable FX, which is our stablecoin FX engine on chain. And all the currencies that we have in stable FX today are emerging markets currencies. We heard this morning in the last session that 18 currencies are in CLS today. That still leaves a lot of currencies out of CLS, which are not protected by PVP. What is the meaning of that, right? Fiat currencies were not meant to build for this, right? They were not meant for speed. But digital assets are. Stable coins and tokenized deposits, they can settle money in real time. But there is a big difference to it. It's not just about settling. These are smart contracts. This is software running to move money. And here, settlement and compliance logic, compliance rules, FX logic, it's all embedded. So the settlement happens instantly. And even on the Circle Payments Network side, we have all the transactions that are happening. FX and compliance rules are embedded in the transactions. And on that, maybe I'll share this one instance, and you may find it funny, but it's actually not. It's about like how quickly people's and businesses, their expectations are changing. So we have had CPN live in the market for almost 7 months now, doing a lot of transactions. Our average settlement time is less than 5 minutes, not average. 95th percentile settlement time is less than 5 minutes. And most of that is dictated by the blockchain speed. And I have a large customer who does decent amount of transactions every day. There was a time I got a call from him, and he said, hey, I have noticed that my transactions are now taking 7 minutes. And I was blown away. I was like, did you forget that we were in a different world? You're now talking about 5 minutes to 7 minutes, right? So that's the world we are in. And expectations are changing very, very rapidly. And I think the TLDR is we need to partake in this new ecosystem, else we risk being left out of this ecosystem, right? So I think that's where I see the world is going, and I'll have more point of views, but go ahead, Will.
Yeah, just to maybe build a little on what Sunil said, and actually I like the way Harsh had opened us up talking about the fact that the traditional rails have actually moved on pretty significantly over the last few years. Around the same sort of time that you'd mentioned, this massive sort of build out of localized FMI really took off. And today, if I look at Citi's network, we're connected into instant payment rails in about 65 markets around the world today. That means you're moving money really, really fast on the ground in a variety of different markets. Add to that the additional build-outs that we've had with things like 24/7 clearing, where banks can settle each other 24/7 and actually handle some of these rails. I think what's really interesting about what Sunil's opened with is actually how stablecoin and tokenized deposits can add to that. And if you think about this, there's still a lot of settlement that is not 24/7. I really like the fact that blockchain settlement is inherently 24/7, and the fact that you're able to move that money around post-cutoff times and settle post-cutoff times. That is something we've seen within our own experience. So when we look at things like the Citi Token services platform, what we've really seen there is if you take a look at a corporate client today that may bank with you in 2 locations, historically to move that money, they would have had to wait for a window to open to do that. The tokenized platform allows them to do that 24/7 near instant. So these are really powerful use cases that are really impactful to clients who have historically had to do things like really strong cash flow forecasting. Now, if you get it a little bit wrong, not really the end of the world. So that, in my mind, when I think about where the platform really helps us, where tokenized deposits and stablecoin can really help us, is opportunities like that where there's a need for a real 24/7 settlement. The second is when I think about some of what was actually discussed on the prior panel, like PVP, the fact that the program, the funding itself and the tokens themselves are inherently programmable means you can eliminate things like settlement risk by programming the transaction to happen simultaneously. Those types of things are really quite sort of powerful opportunities. And then I think thinking about actual core settlement itself as well, there's a huge amount of opportunity in this space. So the sort of settlement mechanisms that Harsh had mentioned, we've done a similar sort of build out like that. But if you think about in-market hour settlement, that's fine. You don't need to pre-fund transactions like that. You don't have to have huge amounts of capital tied up. You can typically just execute a trade, use local branch liquidity to do that. It's not as easy to do that after hours. So again, the 24/7 kind of nature of this is really a very, very interesting play. Although sort of liquidity in certain currencies and the likes may be fairly shallow at the moment, I think there's potential for that type of thing to grow pretty significantly. That will help us potentially push a few more of these types of transactions that way. So when I think about that sort of backdrop on how the actual underlying infrastructure could help move and liquefy the network, I think something that we've sort of seen, at least from a competitive standpoint, to answer the second part of your question is, if we look back at the fintech evolution, it was just banks competing with banks. So it was traditional players up against traditional players. What you're now seeing is a very multifaceted competitive landscape, right? You've got traditional banks, you've got fintechs, you've got card schemes, and now you've got the disruptive players that have entered into the space, all looking at trying to solve exactly the same set of problems. And if I look at what happened in 2013, 2014, when the numbers started coming out of Silicon Valley, I think the banks thought thought our days were numbered. It was kind of the end of the world, and we were all going to be gone in 5 years' time. When I look forward to what's actually happened, I am ecstatic to be part of the payments world as a result of what they did to the payments industry, because the payments industry has done nothing but grow exponentially as a result of their influence. And actually, what has been really interesting is that the partnerships and the engagement between the banks and the fintech industry has been pretty amazing to date, and really been a big part of Citi's own business. We partner really well with several of these fintechs around the world today, and it's been a very exciting world to see how that can kind of grow the payments pie rather than redivide it. And because of that type of backdrop and that type of experience, I think we've been quite vocal again about, from a competitive landscape, that actually there's a lot more to be gained by being interoperable than there is in sort of thinking about it like a zero-sum game. And so that's sort of, I guess, what I would sort of add from a competitive lens, is that I think there's a huge amount of opportunity in the interoperability space.
And maybe, just to add a little bit more based on what Will said, the way we are talking, it may sound like we're talking about speed. It's actually way more than speed. Even though speed is great, and now the settlement is happening from T+2 to seconds, which is great. It's way more than that. It's about counterparty risk. It's about unlocking locked capital. It's about re-architecting trust in a non-intermediary way, re-architecting trust in an automated way, right? And even on the competitive side, like there hasn't been a day, maybe in the last 7 months or maybe last 6 months since Genius, when a fintech or a PSP has not announced something new. There is a news every day from Wise or Swift or Revolut or Robinhood or Coinbase or JP Morgan or Stripe. Like yesterday, we saw Visa announcing stablecoin settlements for settlements between acquirers and issuers. Similarly, we have seen last week DTCC announce their plan to tokenize a lot of securities and assets, right? So this thing is happening. Businesses and institutions and banks are starting to realize the value of this thing that's coming our way, right?
Tom or Harsh, anything to add?
No, I mean, sometimes I love that we're all builders here, but like we get really quickly in the weeds of, counterparty settlement and settlement risk and speed and what it'll change to the plumbing and stuff. I think when you take a step back, I 100% agree with what you said. I think there's going to be a balance of like specific technologies will be better on some things and existing rails will be better on some other things, right? But generally, what I've learned over the last 10 years is like if you look at it from a consumer perspective or a business perspective, the end user perspective, right? Speed actually has been very interesting for us. The number one reason why people call Wise? No surprise. The question is, where's my money? So if you're slow,
that's right,
people get anxious, right? And especially when you're doing a cross-border transaction. So guess what happens when the transaction's fast? 20 seconds, the money's already there. The phone call will be slower than the money being on the other side, right? So your operational costs drop like crazy, right? And then you can turn around and then give that back to consumers from a price drop perspective, and you're still profitable, right? So I think there's a lot of like second order effects which we talk about. Yes, settlement risk reduces when you've cleared, but also like the consumer experience is so much good, it's so much better that it actually reduces the operational overhead. That means you don't need 1,000 engineers to build this company, you need maybe 500, right? But I actually completely agree with what Sunil said, which is the expectations in the market is changing too. I genuinely had a person, a friend of mine, he texted me saying, every time I send money to India, it's with Wise, it's cleared in 20 seconds. And I don't know what's happened, but this time it took 2 hours. I was like, exactly my response was like maybe something got stuck in some RFI check. But that's the expectations that's changing in the market. But overall, I do think like this idea that there will be multiple technologies that will work towards solving the problem. I look at it from an end user perspective is something that we should continue to do as an industry.
Per, can I just add 2 points really fast? So speed doesn't matter if it's the only variable, right? Settlement finality matters. Understanding all of the risk matters. $50 is not $50 million.
Yep.
So when we talk about these new instruments and digital assets, we need to be really, really surgical about how they're going to actually be used. Okay, when you send $100, or equivalent of that in rupees to India, somebody's waiting for that, and they're basically hitting the equivalent of refresh. That's not what happens when a U.S. corporate pays their supplier in Malaysia. Okay, so $50 is not 50 million. Retail is very different than institutional. And if it gets into the wallet or doesn't get into the wallet, when you just send them $50, it kind of matters, but it kind of doesn't matter. If you send $50 million to Malaysia, not only does it have to work, but it has to be traced, it has to be auditable, it has to be compliant, and, right? So they're just different scenarios. But we should focus on speed. And one of the numbers that we published just before Sibos this year in September is 75% of cross-border payments on SWIFT, 75% reach the beneficiary bank in 10 minutes or less. In the main corridors, it's actually seconds, not minutes. So that doesn't mean we're not done, and we should try to make things faster, right? But it tells me we have a last mile problem, and it tells me we have an opportunity with these new digital assets to figure out how we can make that not only more faster and speedier, but safer and more resilient.
Well, thank you. So it's clear there's a few themes coming out of the discussion. So one is the ecosystem is becoming more diverse. It's growing. There are just more actors that are involved in this market, perhaps than traditionally. They're playing very different roles. Some are banks, some are non-banks, some are non-banks that want to become banks. So there's a variety of approaches that are being taken to address perceived market needs. There's also no winner takes all necessarily in this. So some of the innovations that are taking place are additive to the current state and are providing perhaps benefits, but it doesn't mean that the current state and the legacy approach is going away at this point in time. And with that, I'd like to direct the next question to Tom, where when innovation is working well, it's solving some material problem. So innovation isn't useful just for innovation's sake, but ideally it's solving important problems for all of us. So I wonder, Tom, if you could talk a little bit about how the infrastructure is evolving to meet the new market needs that you either have validated today or are perceived and are solving identified problems. And what are some of the key technologies? What still needs to be solved beyond that? So where are there opportunities to do more that we haven't figured out yet? And are there any unintended consequences from all of this? Are there new risks or other things that we might need to consider?
Sure. So let's zoom out a little bit in terms of FX infrastructure. And what we're broadly seeing, and as Sunil said, there's kind of an announcement, feels like every day, from different sectors and different participants in the marketplace. But one core thing that we're seeing is really moving from messaging to the coordination of settlement across multiple locations, right? So we've been doing messaging. We turned 50 years old last year. We've been doing messaging. It's going to be here for the foreseeable future, but it comes with the shortcomings to that, right? When you have messaging, you have to do things like reconciliations, right? And so there's an opportunity to improve these things. And I think one of the things that I would challenge you with to think about is, can we take advantage of these things without centralizing the market, right? When we start talking about private ledgers or public ledgers, the idea is decentralized finance. So what I don't think is going to happen is we're going to come up with CLS2, right? Or kind of some equivalent of that to kind of centralize it. The question is, can you take advantage of things like decentralization, as you move from kind of messaging to coordinating settlement across multiple locations? And so that's something to think about. That's why we announced the Swift Ledger, and that's why we think it's foundational. So we're still going to do messaging. We're still going to do everything we've done for cross-border payments, for FX, right? The way that I got to Swift is that we use the Swift net to connect all the member banks, which are 73, 74 member banks now. That's the way in which CLS connects to RTGS systems and central bank systems, right? So we know these work, and we're not doing anything with the network. We're going to continue to invest. We're going to continue to make it more resilient. We're going to continue to modernize it like we have been doing for 50 years. What we're going to do is we're going to run blockchain technology on top of that. And that gives us the opportunity to look at, can you start to take advantage of these assets with the with the banks, with the financial institutions that are regulated? And can you do that without kind of further centralizing the market and taking some of the advantages of decentralization? One of which is resiliency. We always talk about resiliency. Well, just the nature of things being decentralized, by definition, has an opportunity to make it more resilient. How are we going to do that? I don't know. There's an opportunity we need to explore. This is why we innovate. We also know that we can remove settlement risk. CLS has done that. I mean, it's really well timed that we're here the day after they ran the record settlement run ever, right? So we know that can be done. So I guess the question is, what's different now? One of the things that I would offer to you is really PVP, safety at scale, with the new digital assets or some combination of fiat that we have today. And I think we could acknowledge that the fragmentation is going to continue to exist as it does in the market, and some things are really hard to control, right? Policy choices in a country, fragmentation that comes from that, from currency controls or local market protections or legal finality schemes, right? You have to have legal finality in your law to be able to have settlement finality. That doesn't exist in every country in the world. Those we're not going to overcome with new technology. So I think there's three things. One is get to PVP in, I would call, near real time on state-based systems and be able to coordinate the settlement between different settlement locations. And the two examples that I will bring up is one, and the people in this building would know, Larry Sweet, who is a policy executive here, has come up with a new business process called Project Izzy, which is really interesting. And we just published results from a trial that we do with Citibank on a live payment that actually settled a stablecoin on Ethereum and the fiat leg through the corresponding banking Nostra Vostra accounts, a live payment. Now, that's not scale, that's not for everybody yet, but it's actually happening, right? And we need to be able to plan for that, and we need to be able to continue to evolve what we're doing here. So one thing to really watch and kind of where we see the evolution happening is in this real-time, in the real-time payments. I think the second thing is, we talked a lot today about algorithms driving price and liquidity and position management and kind of skewing to manage positions, that sort of thing. You can actually do the same thing with market infrastructure. It's not just for trading. Okay, and for years and years, for decades now, banks have had algos for pricing, for liquidity management, for risk management, for all those things. You can now embed in these new assets settlement rules, compliance logic. Programmability is super powerful. Not only is there a token that points to the asset, but it can actually execute on certain transactions in certain conditions. That's powerful. I don't know exactly how we use that, but that's powerful. And then I think the third one is this cryptographic assurance and interoperability so we don't build more fragmentation. So we have a really, really good opportunity as an industry to kind of repeat things that we've all been cleaning up for the last 10, 15, 20 years, where everybody builds a digital island, they don't focus on interoperability, they don't do it in a standardized way, and you get all of the problems that you have with fragmentation. We have that opportunity to do that. We're trying to launch the Swift Ledger to help the industry adopt, when it makes sense and when it's ready, these new digital assets, so we don't rebuild the past the same way that we did in the past. And so there's tremendous opportunities in all those things. Again, I don't have a crystal ball. I'm not saying those are going to happen tomorrow, but we have the opportunity in those three areas, and that's what I would highlight as I think probably the best opportunities in terms of infrastructure and what we see evolving now.
Could I maybe add to a little bit of what Tom said? I think it's really interesting, a couple of observations that you've brought up. And I think one that we've sort of, I think, looked at and seen from afar is there's a huge amount of infrastructure being built up, and the fragmentation risk in this segment in particular is real. Because what you do have here is multiple different chains, multiple different tokens, multiple different coins offered by multiple different counterparties. And what's kind of interesting about that is, initially, if you think about the initial philosophy of this segment, the idea was, let's decentralize, let's do away with big central intermediaries. And what's actually kind of happening here is a redefinition of what an intermediary is and what an intermediary does. So you have a concept like a bridge, which never existed prior to this world, right? If you're on the wrong chain and you want to settle onto another one, there's a bridge that can help you do that. An intermediary like that didn't really exist before. You could maybe point to things like corresponding correspondent banking networks that kind of looked and felt a little bit the same. But those are sort of prime examples of how the role and the definition of an intermediary is being redefined by some of the segment as well. And then just to touch on one other point you made about speed, and I like that you specifically mentioned it around B2B payments in particular. I don't know how fast the business needs a payment to be when it knows the payment's coming in 90 days' time. You know, it's kind of an interesting dichotomy to say you can settle right now if you really want to, but they actually know the payment is coming 90 days ahead of time. The friction really for them is around when they make that payment, how long does it take them to settle so they can reconcile it? And transparency is a huge, huge component of that sort of body of work. So I think there's some interesting pieces on the transparency side as well.
And how much they're paying for the transaction as well.
100% agree. How much you're paying, and the paying usually comes from the intermediaries and the processing and what is happening in the intermediaries. I think if you ask most businesses, they will say, if I can hold on to float for 89 days, I will. Why will I not, right? So there is this idea of like money, the longer I hold on to the money, the more money I make. So there is, if I can get paid faster, I will, with everything that Tom said about being compliant, being like, the price being lower and everything else. I will echo what Will said, which is actually something, like as a technologist, when this distributed ledger technology came out, and I was super excited too, and I'm still excited, but the interesting direction things have gone in around fragmentation is very true. Like fragmentation risk is basically we're playing out everything that happened in payments very quickly, but it seems supercharged. Like what took 20, 30 years, if we go down this path, there's a likelihood, if we don't have interoperability, it'll end up in like 5 years, right? Based on which tokens get adopted, and we're just talking about the US right now, right? Like the world hasn't played this out yet in other countries either, right? So I mean, if you look at the overall, just talking about digital assets and tokenization of the dollar, like overall the stablecoin marketplace, like 99% is just USD, right? So this is going to be a very interesting game and how this plays out with private issuers, with some governments looking at this, like in the RBI wants to control the rupee, and then you've got on-ramp and off-ramps. So you go back to, in a way, like you kind of go back to like, what did we build here as a Frankenstein on like interoperabilities?
I like the rebuilding of the payments things we've learned, because if you look at like Ethereum's fraud protocol, it's got a 7-day challenge period. That sounds a lot like checks.
Or ACH chargeback or whatever. Yeah, exactly, yeah. So yeah. But as Tom said, it's an interesting space. We're still figuring out how to use some of the technologies, but it will be definitely an additive.
We got to figure out how to take the innovations in DeFi that have worked really well and apply that to what we do today.
Agreed.
Right? So I mentioned resiliency is one. If you start to move a large portion of the FX market to PVP, you don't have settlement risk. Yeah. But to your question, Pierre, you have other consequences to that. There's an ability to correct trades or to fix something in 2 days before it settles now at CLS. Mm-hmm. If you set it instantly, you don't have that ability to correct anymore, right?
Or liquidity issues.
Yeah, and you could have liquidity issues. So it's like any kind of, we need to take those innovations where you now can do PVP. We probably can do that at scale, but then you have to think about what are the other, what else does that break? And is the market incented to do that? I mean, the funny way I describe it is, one person's friction is another person's P&L, right? It's like, well, that's slow. That takes like 4 days. Like, well, so who's doing something for 4 days with it, right? I mean, so if you kind of think about both sides of it, I told you I didn't have a standard disclaimer. I can say whatever I want. If you think about the side of it, with all new technology innovations, there's really, really great things going to happen. And of course, there's going to be consequences. And the important thing here is that we steer the innovation to get the great things that really move the industry forward, and then go in kind of eyes wide open and fully understand the risk or the consequences of making this decision, make sure they're properly accommodated so we can do this at scale in a safe way like we do today.
Absolutely, and in the spirit of driving constructive innovation, hopefully we're not repeating the same errors that we've made in the past relative to fragmentation and other things, but are making new mistakes in the future that we then need to figure out, but will lead to greater benefits to the markets. And another comment that you made, which I thought was interesting about the 90-day terms, for example, we could be in a situation where some of these new capabilities enable things like terms to change. So in the past, terms like that existed for perhaps structural reasons beyond business reasons. And some of those structural reasons might change over time, and that might lead to other changes in the market that could be constructive. So lots going on, certainly, and some stuff we know. To Tom's point, one of the exciting things about this space right now is that it's happening for real. We're past the experimentation phase with much of it, although experimentation continues. But we really have evidence in the market about the performance of some of these things, some of the problems, some of the opportunities, and that's a really exciting point in the development progress. So the next question I'd like to ask Harsh to lead on. And here we've talked about some performance characteristics, some numbers earlier. So we've heard about the SWIFT survey relative to payment settling in 10 minutes or less. We've talked about speed as one of the critical characteristics that we talk about, but also that that's not sufficient on its own. So Harsh, could you let us know from your perspective, what are some of the significant performance characteristics that you think have been improved upon? And what might be next? Are there other performance characteristics that we're looking at that we're trying to improve, that we're trying to solve for? Are there KPIs, key performance indicators that you could reference? And again, we've heard about speed, transparency, cost, access. Are there others beyond those that we might want to consider?
No, I think, like if you look at the metrics, and this is how also we measure ourselves, I think for most payment businesses, especially cross-border payments, those would be the key metrics, right? So like, how much does it cost to move payments from point A to point B? What is the speed at which you can do it? What is the, do you know how much you're paying, like transparency? And then eventually you talk about resilience and risk management stuff, everything that Tom was saying earlier. Moving $50,000 is different than moving $50 million, right? But if I look at each of these, like if you just go one level deeper, I guess one of the things that I've seen now over the last 11 years is how this has evolved, not just only in the US, but across the world, right? So again, as I said before, for us, by connecting directly to real-time payment systems across the world, we've been able to move payments now within 20 seconds with all the compliance checks and everything that's needed, end-to-end from bank account to another bank account in another country for 74% of our payments, right? And this is at scale, like $200 billion cross-currency, $200 billion being moved in cross-currency every year. But then if I look at also pricing, so just give you some stats. Before we connected directly to the Australian payment system, our in and out instant settling rate to Australia was 24%. Once we got a settlement account with the Royal Bank of Australia and direct connectivity, that number went up overnight to 84%. That is the power of instant payment rails that exist today, which moves people's salaries in these countries, which is being used for making mortgages, which is being used to do contractor payments and everything else you want to do, social security payments, right? And these are flushed out systems that have been working for a long time. ACH moves $60 trillion every year, through which all benefits go to everybody in this country, right? So these systems actually scale out and pretty resilient and work pretty well. A lot of times access is the question, right? So that's kind of one of the metrics that I could share on how things really move in the real world. Also in the UK, we became the first non-bank, like as a payments company, to directly connect to the real-time payment systems there. When we did that, pricing, like the cost to do a payment went down by 9x because we were using a partner bank before, right? And they had their own revenue to manage. 9x reduction in price, we were able to turn around and give a 20% price drop for folks. But then the key thing, last bit I would call out is, which is usually least talked about, is transparency. So if you look at just the numbers we've seen in the US this year, I'm talking about retail payments, so a little bit further up the stack. But it's the reality, if any of you move money around the world, this year, across the US, people will lose $38 billion in fees just on FX markups. I let that message land. $38 billion, because most people in the country do not know how much they're paying because the FX markup and FX rate has all the fees in there. Because if today I would ask most people, I do this experiment when I talk to people, like, where would you go if you want to see what is the actual FX rate between USD and Euro? They'd say, I'll Google it. That's the right answer. But when you Google it and then you go to your service provider, that rate is not the same. And guess what? The actual retail fee line, because Reg E requires you to disclose your fee, it says free. There's nothing called a free lunch. All the free fee is in the FX, right? So we build a business differently where we actually use the Google rate and then we disclose our fees. I think that drives better, consumer choices. But the reality is, a lot of the fee is in the FX markup, and it's like, usually 4 to 5%. And we've seen where regulators have pushed for this transparency. Things have in Europe, this is happening now. Things are going down because there's competition and people can pick and choose, right? So I think that's the other metric that we have to measure ourselves against, because there's otherwise no drive to make the product better for consumers.
Great. Well, we have both the blessing and the curse of being the last panel of the day, and also the one that's right before the reception. So I'm wondering, do we have time for 1 or 2 questions, or is that okay? Okay, so then I'd like to just open it up to the audience to see if we have any questions for the panel.
Hi, Bastian from the Federal Reserve Board. Just to get a sense of what growth you're expecting for stablecoins. So currently, total stablecoin market cap is around 300 billion, I think, roundabout. So in, let's say, 1 year and 3 years, what's your forecast where it's going to be?
I would point to one report is that Citi just did on stablecoins 2030, right? They made an estimate of somewhere between $2 and $4 trillion in US dollar stablecoins by 2030.
Yeah.
That's pretty consistent with what you heard from Secretary Passant, for example, when he talks about stablecoins in the market. So that's kind of the order of magnitude that they're talking about. People are kind of circling around right now. Whether that happens or not remains to be seen. But and then today is about $300 billion of value on chain.
I think if you scratch below the surface at that number, what's kind of interesting is what's going to make up that number, right? So the report specifically goes into how they think that number will be hit. And it talks about 3 different things, right? So the 3 things it talks about in particular are growth in retail investors in dollars, and that's a big driver. So this is, think about people stuck in a trapped cash hyperinflation market. They're going to want access to something that's a little bit more stable. The second is conversion of currency. So the view is there's conversion of physical dollars. I don't want to go against my Citi Institute friends. I come from Africa. I grew up in South Africa, spent the first 10 years of my career delivering payments in the last mile. Converting Africa from cash is going to be very, very, very hard. It is a very trapped cash market, and it's a cash-based market for a number of reasons, one of which is effectively cultural. People have a general fear of institutions. They don't care what that institution is, but that's a big number, so the potential to convert currency. And then the third number that's quoted in that is essentially the number that's around growth of additional e-commerce oriented use cases. So if you think about those three levers, that sort of should give you some idea, at least from a Citi institution research perspective, where they think the kind of core demand is going to come from that will drive the potential use. What I think is a little interesting, though, is if you look at the growth in market cap and stablecoins in the backdrop of the market cap for cryptocurrency over the same period, it's actually declined $600 billion. In part because of reduction in the value of certain public cryptocurrencies. And I wonder whether some of that is a swap out from public crypto into stablecoin as stablecoin has gained more regulatory clarity. Because if you think about something that's very or kind of similar when you think about leapfrog technologies, have a look at something like M-Pesa in Kenya. What actually made M-Pesa in Kenya really successful was, one, its cash kiosk outlets. It created a last mile mechanism to deliver seamless funding into users. But the second thing is it got regulatory relevance. So the Central Bank of Kenya regulated them into existence. So those are pretty important sort of metrics that help drive adoption within markets.
Can I just, again, just for things you to think about on the way up, because we talk about kind of the total value, the crypto people say TVL, total value on ledger, right? And whether it goes from 300 billion to 4 trillion, whatever that is, consider something else. Today, everywhere around the world, all of the settlement systems that run are either run by a central bank, where the banks participate and regulated institutions participate, or the banks own it, like a CLS or a SWIFT or a DTCC or Euroclear, that sort of thing, right? Today, there's $300 billion of value on chain, which means there's certainly demand for digital money. There's no doubt about that, right? But it's $300 billion on chain. Who owns Ethereum? Circle, I think Circle settles the stable coins, on 23 or 26 different blockchains. Who owns those blockchains? So right now we have everything's done by a central bank and or banks or some combination of everywhere in the world, not just US or Europe, everywhere in the world. And now you have, one of the most widely used stable coins today. Probably half of that traffic's on Ethereum. Nobody owns Ethereum. Nobody owns the 23, maybe some venture capitalists do, right? But nobody owns the 23 or 26 settlement utilities that have been used for stable coins. That's interesting, right? That's really interesting. So it's not just the headline number and the value. It's like, well, how does that work? And what does legal finality mean, from a B2B institutional point of view? What does that mean on Ethereum? We don't know yet, but it looks like we need to figure these things out.
Yeah, I'll add to what Tom's saying. I think there will be a trust spectrum, right? So there will be folks who will be very cynical around who owns, and eventually, people put money into treasuries and have done that for decades because they trust the US government can do something if things go wrong, right? And that is very different than when you start settling on Ethereum, right? So there's going to be people on that spectrum, and there's going to be people like Will said, right? From our perspective, we are seeing definitely there is this thinking of more than currency. We are seeing this as, for a lot of people, as a hedge against their local currency as an asset, right? So if you live in Brazil, if you live in Argentina already, if you go to Argentina, Buenos Aires, you want some dollars, some person will come and probably, hand you dollars for your pesos, hand you pesos for your dollars if you want to, right? So that can translate onto the chain, but generally, from what we are seeing from our customers too, a lot of this is the growth will come from hedging against a volatile currency, which may not be the same as having a currency that is native, that you're transacting in at the same scale. But that's in early days. But this trust thing will be something that has to play out across the spectrum for businesses and consumers.
So this is definitely trust. We'll clarify what are the components where this money is going to come from, right? So we need to think about two things. One is the stock of money. Second one is the velocity of money, right? So some of this money, like I talked about earlier, trillions of dollars moves per month, right, in stable coins. From what stock of stable coins, right? So I think you also need to look at what the multiple is going to be. Like if there is $3 trillion in stock of stable coins, how much of transactional activity is it going to drive?
Well, thank you. Clearly from the discussion that we've had, there is a discussion about speed within the FX markets, but there's also speed of innovation. There's just so much going on now. And these are just some examples of organizations and initiatives that are moving ahead, trying to solve problems within the FX markets, deliver new capabilities, deliver new value propositions. And it's unlikely that's going to slow down. So I think we all need to spend even more time trying to understand these trends that are taking place, the implications of these trends, how they're solving meaningful problems, but also what still needs to be solved for within the markets. So before we head off to the reception, please join me in thanking our panelists for the interesting discussion.
So I just want to close out our conference by sharing that on behalf of the New York Fed, we want to express our sincere thanks to everyone who actively participated in our conference, both here and who joined us online. I think reflecting on today, Per, as you alluded to, we've had a number of rich discussions and on some panels, some debates around the key issues on FX market structure, especially across the diverse ecosystem that makes up this market. So I've walked away with a lot of food for thought and actually started writing down some topics of panels potentially for next year's conference. So I would like to just close out by saying thank you very much to the events organizing committee for making it such a great success today. Martin Prusinowski, Fabiola Ravazzolo, Dan Reichgott, and especially Sabrina Lashenko, who just made everything run behind the scenes so smoothly. So thank you very much to the team. And as Per mentioned, we have a reception on the first floor, so look forward to seeing all of you there. Happy holidays and Happy New Year. Thank you.